Hello. Hi, all my participants. Can I hear you all?
Yes.
Okay.
Hi, good evening, Bhawna.
Hi, very good evening to all of you. Very warm welcome to our very first session for CPA Chapter 1. So, how are you all feeling today? Excited? I know a few of you
Yes.
are
Yes,
really
excited.
excited.
Yeah.
Yeah, so am
Yeah.
I. Yeah, so very nice. I am expecting actually a couple of more participants. So one is, of course, Sandeep Sanjay. He would join us from Dallas, US, and there are a couple of more. So Sumanta, how is your journey going on? I know that you have been studying for.
Yeah, fine, but not too much because since I have my bridge course exam, so I'm juggling a
Okay,
little bit with this FAR and bridge course.
okay, okay. All right. So Payal, how about you?
Hi, ma'am.
Hello,
So,
Payal. Yeah.
yeah. So, I have just started, but I thought that I will go with your flow. So, I just stopped that and I thought that I will start the journey with you only. So
Okay.
that's
Very
why
nice.
I have stopped watching the previous lecture. So now I will start from today actively learning the CPA part.
Okay. Very nice. So you were earlier enrolled with Simandar, right?
Yes,
Or
yes,
at
ma'am. No,
Simandar.
no,
So you
Simandar,
have
ma'am.
Becca with you.
Yes, yes, Baker, ma'am. Yes, ma'am.
Okay, okay, okay. So Lohit, hello.
Hi, ma'am. Hi.
Yeah, hi Lohit. So you are in Mysore today or in Bangalore?
Yeah, Mysore.
You are joining us from Mysore.
Yeah.
Okay, very nice. So Lohit, you do not have any other educators material with you, right?
No.
Okay, so you are starting fresh today.
Yeah.
Very nice. Sarthak, I know you have joined Simandar and you already have Becca material with you. So for Sarthak, Kavya and Sumanta, I'm already aware. So, okay, very nice. Sandhya, I know, yeah. So she's joining us from office. So she messaged me that she won't be able to probably interact much today. But Sandhya, hello, very warm welcome to you. I know Sandhya is extremely, extremely excited today. So very nice. So Kavya, I know I am completely aware that, you have been with Samantha for quite some time and you have Becca material already with you. Sandhya says, yes, she's very excited. So are we. Hi, Indu.
Hello, how are you guys?
Yeah, so,
Can
yeah,
can you
Indu,
hear me?
what's the time today? I mean, right now,
Time is 6:36 morning.
6:36. So, Indu has joined us from Toronto, Canada. Okay, so, all right, very nice. Sanjay, hello, very good
Hi,
morning to you,
hi,
Sanjay.
Bhavna. Yeah, hello.
5 o'clock for you?
5:36.
5:30. Yeah.
5:36.
Yeah.
Okay. Very good morning to Indu and Sanjay. So Sanjay is
Good
joining
morning.
us from Dallas, US, and Indu from Canada. So very nice. I think और किसी को आना है क्या? I'm not really sure. Anyway, so if anybody joins us in between, it's okay. Now, you know how we want to basically proceed further is that I will tell you after these, at least, first couple of weeks, I will start telling you the task-based simulations that have to be covered. Okay. So the task-based simulations, all of you are aware, are very, very crucial to pass CPA exam. Hi, Harshit.
Hello.
How are you doing, Harshit?
I'm fine. Sorry,
You
I'm
are
late.
you are joining us from New Delhi?
No, I'm from Assam right now in Hyderabad.
Oh, okay. Very nice. Very nice. So, for Harshit, this is a demo class. So, I'm sure that Harshit, you would maybe, you'll join us after the demo class gets over. So, that's what my best expectation is. So, all of you are aware about this FAR. once again, quickly, we have 5 testlets, okay? And it's not that I am going to cover only and only this will be your exam-oriented study, because I understand I've been in industry, in practice also for quite some time. And once you have the certification, the expectation once you are working is really high in your office. Okay, so people expect you to perform more, much better than what others are performing. People expect you to have a good amount of conceptual understanding about the topics. Okay, so immediately people will start expecting that you are Google yourself. At least, you know, in my organization, this was the expectation of my teammates, that anything you do not know, just go and check with the CPA. Okay, so we will prepare ourselves to that level so that, of course, yes, we are able to crack the exam, not just with 75 percentile, but for us, 95.5 is what we target to achieve, which is not that difficult, because we will do strategy wise. Okay, so we will form a good strategy and we will stick to it. So all of you have to listen to the timelines that I set for you. After most of the classes, I will tell you that this is what you're supposed to cover during the entire week. So your entire week means about 5 days you have to take, because one day you will take off. And on the day of class, of course, yes, you would not want to study. Okay, so but those 5 days you have to do at least 2 hours a day. So, and I really don't think that 2 hours a day is too much of commitment, because anybody who is a chartered accountant already, they would know that, you know, when you are doing your articleship, this is what is the minimum requirement that you have to do. In fact, for CA, more is what is needed. Okay. So 2 hours a day. If you are not able to manage 2 hours at a stretch, then bits and pieces. Okay. Don't think that I need 2 hours or at least 1 hour in a stretch to crack. No. Even if you are able to get 10 minutes, 15 minutes, whenever it is possible during the entire day, you take that time out and do at least something. Okay. This is how we will frame, and then end of the day, you will realize that you have actually covered more than 2 hours. So which means a substantial portion you are covering on a daily basis. All right. So this is what my strategy was when I was preparing. I was working. I had 2 kids with me that time. Now I have 3. Okay. So the challenge is increasing, but you know, the strategy still remains the same for me. Whatever time I get during the day, even if I'm able to read at least 1 page, I have to read at least a page, or half page also, I will at least do that. So that half page, 1 page cumulatively helps us a lot. Okay. So this is strategy number 1. Strategy number 2 is that the conceptual understanding will be given at the time of lectures. You have to revise those concepts. Okay. Plus, application part of it is very, very important. Application means that wherever in your office, because most of you are working, okay, you would see such scenarios. Don't try to escape from it. You try to apply whatever you are learning here in the class practically also, because that application will help you crack the task-based simulation. Task-based simulation, which covers 50% of the weightage on your exam, is completely based on what you will actually do in your office practically. So they will sometimes provide you letter from an accountant. Sometimes you will get a letter from an insurance company. Read that letter, what is mentioned in that letter, apply that information in the building up of your income statement or passing of some journal entries. Okay, so whenever in your office also you see this, try to relate it to the concepts that you're learning here in the class. Point number 3 is multiple choice questions. Do not wait for time to solve that multiple choice question. It should be readily handy always with you. Okay. Do it minimum 15 questions in a day or 10 questions in a day. After you are done reading the concept, enough number of practice problems are already incorporated in our resources. Okay. Do those practice problems. Some of those practice problems will guide you how to do the task-based simulations, but most of them will be multiple choice questions. So multiple choice question always, earlier also I have told you, you have to go to the bottom of the line, okay, of the entire question, because I will tell you, they try to test you sometimes by giving lot of irrelevant data also. So that irrelevant data should be filtered out in your first reading itself. For this, you should know the requirement of the question first. So read that first requirement, which is given always at the bottom of the question. Then you start reading the question. Okay. So always when I ask you to do the multiple choice questions in the class also, okay, you have to keep interacting with me as if you are physically present with me. Okay, in a class. If you do not talk to me, if you do not interact with me, then this online class is not going to help us. Okay. Don't depend only on those one-to-one mentoring sessions. Okay, because you have to again take out time for those one-on-one sessions. I am in any case available, but you will have to, out of your busy office schedule, take out time for those sessions. Better try to get all your queries solved here in the class itself when it is being taught. All right. So I will ask you that, okay, Kavya, please do this multiple choice question for us. So Kavya would first read the very last line of the question. In most of the cases, the requirement would be available there. Okay. And then you start reading the entire question, then give me the answer. So Kavya, once he has given the answer, then the rest of the participants are also supposed to give their answers. It's just not the person who is reading it will answer. So we have to stay alert and attentive in the class. And that's how we plan to crack the exam in our very first attempt, because for me, second attempt will not exist. Okay. Although I will support you till the very end of your CPA journey, that's my commitment, my promise to all of you. But we have to make sure that we pass it only in the very first attempt. And for this, affirmations, every single day, morning when you wake up and night when you go to bed, you have to keep yourself in that mode. You have to keep yourself giving those affirmations that, yes, I am already a CPA. Because from today onwards, all of us are starting this new journey. Okay. I am holding your hand. Don't worry about it. I'm not going to leave you until you all actually cross this ocean of CPA. But please try to do it in the very first attempt itself. Okay. And for us, 95.5 is the target that we want to achieve. Okay. And then we all party. All right. Party where? In Goa. That's my dream. So Indu and Sanjay will need to travel to India.
That's
to
fine.
party
We
with us
will.
in
We
Goa.
will.
Sanjay, I didn't hear you.
Yeah, definitely.
Sure?
Yeah.
ठीक है. So now, participants, all of us are a team. Okay. Now, what is really important? Yes, Sunday are done. Now, what we will do, we will first form groups. How many of us are here? Hoping that Harshit is joining. So 1, 2, 3, 4, 5,
11.
6, 7, 8, 9 are there. Okay. So let's make 3 into 3 groups. Okay. 3 participants in each group. One participant in the entire group for 1 week would be the head of that group. For example, Harshit, Lohit and Sarthak are in one group for 1 week. Okay. Now this group is going to remain like this, but the head will change in the next week. What is this head supposed to do? Monitor the progress of the other participants in the group and then report to me. Monitoring the progress does not mean that you have to spend a lot of time as you do in your office if you are the manager. No. You only have to spend in a week about 5 to 10 minutes. Talk to your participants. What are your challenges? Where were you stuck? What is the most difficult MCQ or the most difficult task-based simulation that you have come across? What was the challenge? Is there any conceptual issue that you are facing? Okay. Or in the content, you feel that something is missing, or in the content, something more should be added so that you are able to understand better with illustrations. Say, for example, for the first week, Lohit becomes the head. So end of the week, Saturday, before we all meet, Lohit will give me a report at least on Friday. That, ma'am, Sarthak's progress is this. So much he has covered. Harshit's progress during the week is this. Similarly, say for example, Sumanta, Payal and Sandhya are in the same group. Sumanta becomes the head in the first week. In the second week, Payal becomes the head. In the third week, Sandhya becomes the head. Okay. And then Kavya, Indu and Sanjay. So all of you, please write down the names of your teammates. This is your team for the next 18 months or 15 months. Okay.
What you said, Payal and Sandhya.
Payal and Sandhya are in your
Okay.
group. Is that
Okay.
okay, Sumanta?
Yeah,
Comfortable
yeah,
with two
absolutely.
ladies?
Yeah,
Okay.
yeah.
So Sumanta is a very, very dedicated student of mine. Payal and Sandhya. He is extremely helpful. Okay? I am
Okay.
sure that this network is going to help all of us later also. Because you all of us are professionals here, right? So once we are friends here, we are friends for the lifetime. We are going to help each other not only in the CPA journey, but after completion of CPA also. Tomorrow when we apply for jobs, each one of us is going to be helpful to each other, right? So similarly, Kavya, Indu and Sanjay, they are in the same group. So one person heads the group in the 1 week. Second week, somebody from the same team is going to head it. How does this sound?
This
Good,
sounds
good.
amazing, but one,
Yes,
yeah, I
very
will be
nice,
away
ma'am.
for 3 weeks. So we need to check for that. I told you, right?
Which is perfectly fine.
Yeah.
When you are aware, it is okay. We can
Then,
manage it
yeah,
because,
Sandhya and Kavya will take care. Yeah.
they will. But
Yeah.
again, they will check your progress.
Yeah,
And even if you are
after
away,
that, I
does
will,
not mean that your books are closed for 2 or 3 weeks.
right. I will
If you are
catch
on
up
a
with those
vacation,
guys.
my expectation is that even if you are not able to attend the sessions, it is fine. But you have the recordings available with you. Go through those
Right.
recordings at least.
Mhm.
Okay. And
Yeah, I will try
it's
my
also
best.
important
Yes.
to keep doing the multiple choice questions and the task-based simulations. For task-based simulations, I will guide you. We
Right.
are not starting with the task-based simulations at least for the next 2 weeks. Why?
Okay.
Because I don't want my participants to end up wasting time. First,
Mhm.
we understand the concept. Many of the things that are given in the task-based simulations are interrelated topics. So at least understand some part, okay, of the
Mhm.
financial statements, and then we can go over to the interrelated concepts that are given in TBS.
Mhm.
So all of you have please noted down the names, okay, of your partners, of your teammates. And then the progress has to be monitored. So for the first week, Lohit becomes the head of team A. So Lohit, Harshit and Sarthak are in team A. Okay. Team B is Sandhya, Sumantha and Payal. Sumantha becomes the head in the first week. Okay. Of team B. Team C is Kavya, Indu and Sanjay. Kavya becomes the head of this group for the first week. And then later you can change the group head. Correct? And you have to please take it very seriously because this strategy has shown really very good results in the past.
Yeah, good study. Yes, yes.
Your monitor on a daily basis is being tracked. I cannot track the progress of my participants on a daily, hourly basis. But each one of you has to take that responsibility. Okay? And no jealous factor at all. Agreed? Okay.
Yes.
You have to
Agreed.
help out each other so that you
Yes.
also get the same help from the other person.
Mhm.
Okay. Now, the most important part, I will cover this entire FAR in 3.5 to 4 months. I do not speed up. I do not speed up. However, I have complete capability of speeding up. So if my participants after some time start feeling that no, we have understood the concept, we are comfortable with it, you can speed up. Then I will speed up and my speed will completely be driven by my participants. So tell me, okay, I will start at my own pace as I've been teaching for about 11 years now, but I will keep changing my pace depending on my participants' comfort. Okay, so 3.5 months is approximately we will take to finish the FAR syllabus. Now, once we are done with it, so 1 or 2 weeks here and there should be fine. So once we are done with the FAR syllabus, because all of us are team here now, so we will all take a break for about 3 to 4 weeks. and write our exam, all of us together. So within that, somebody might say that, I don't need a lot of revision because I've revised many number of times during the classes itself. That person can take the exam after 2 weeks. Somebody might say that, no, I need 4 weeks time to revise from my side. Okay, because minimum 3 revisions is what is needed. So, okay, you can write after 1 month. The class will wait for all of you to return back, but only for 1 month. So 1 month means maximum 3 to 4 weeks time. I will give to all participants to write the exam, come back after passing. So after 4 months, you can expect that all of you will be done with FAR, which is probably the biggest phobia. I don't think it is a phobia at all. It is an extremely interesting subject.
Bhavna,
Then,
I have one question.
yes.
Regarding my evaluation, it is saying international evaluation fee payment. It is pending for near about 1 month. I am mailing, but they are not replying. What to do?
Yeah, so we will take up that query after the session. Okay, so
Okay,
probably
okay.
tomorrow we can discuss or on Monday.
Okay, sure.
Okay, so whoever has any queries related to evaluation, let's all have a separate meeting. Okay, we will discuss the evaluation part separately and get it done. Don't worry.
Okay.
Okay. So after 4 months, I'm expecting that all of us would be ready to write the exam. We write the exam, come back, and then all of us start preparing again for audit. Okay. After 3 to 4 months, between this period, we will be done with audit because audit is huge. Okay. Take a break again, revise for the entire audit ourselves, and during that period, of course, yes, one-on-one mentoring sessions will go on rigorously. Okay, so I will be open and available for the entire week, for the entire day. Okay, so you can just block my calendar and we can have a meeting, one-on-one session during that entire 1 month. Exclusively, only one-on-one sessions would be available. Fine. So after you are done with audit, then we will start with our tax. After we are done with tax, again, we will take a break and then our discipline subject. So my recommendation to my participants is that let's all decide to do only same discipline subject. I am most comfortable in bar because I am subject matter expert in finance. Okay, and bar is nothing but an extension of finance. So all the heavy topics in finance have now been shifted to bar. There is some portion from management accounting also. Partly that management accounting portion has been shifted in FAR now. But more or less, the heavy topics are there in bar. But don't worry about the heavy topics because that's where, my expertise lies. I will walk you all through that. But anyone who is not comfortable with bar, they may choose to do other discipline subjects. Then also it is okay. So, but first, let's try to focus on the core subjects and crack these 3 core subjects, crack them, and then come back and discuss then what do we want in our discipline. How does this sound?
Excellent.
Yeah.
Good, good.
A very good, ma'am.
Excellent.
All of you agree with this plan?
Yes, ma'am.
Yeah.
So we will stick to it because, Lohit, you have not replied. All of you have to tell me if you are comfortable with this plan, because I will then plan my classes accordingly, exclusively for the participants. Okay, so whatever my plan is that we should achieve 100% success. No second writing of exam after FAR. Yes, Sandhya. After FAR, you all give this FAR exam, clear it, and those 3 to 4 weeks will be available. You will be able to do the entire revision because I will make sure that while we are doing our classes, you are not only doing or reading it for the first time, but the revision also happens because your team leader will make it happen. Okay. And then your one-on-one sessions are also available. So I really think this strategy has worked in the past very well. It has given good results. Now, also going forward, it is going to help the participants. Okay, I am exclusively available to help you all out. Right? Sure, sure, sure. So anyone who has any other queries other than this can connect with me later. So we are preparing now for the 5 testlets that are there in our FAR exam. First 2 testlets are multiple choice questions. The last 3 testlets are nothing but your task-based simulations. Okay. One break will be given in this 4-hour long exam. I do not recommend my participants to take that break. Okay. It's a 15 minutes break which is given. I do not recommend you all to break your flow of exam. So we will prepare accordingly so that you all are able to stretch for 4 hours. I don't think it is such a long time when you all are sitting for 4 hours during your class sessions or 6 hours in your class sessions. Okay. So now the LMS thing. Okay. Anyone has any queries till now? Any
No.
queries?
No.
So, Bhavna, just one question. Like, if during the class I have like some question during the week, I will say, then there will be like one-on-one session, or how does it work?
Yeah. So you can first write me on WhatsApp in that knowledge group. Okay. That's the fastest mode. Write to me your query in that WhatsApp group. If it's a small query, I will immediately answer it. Or if this query needs some sort of explanation, then I will ask you to block my calendar. I am available every Tuesday and every Thursday from 5 to 7:30 in the evening India time. Okay, Sanjay?
Okay, thank you.
So most of the cases 20 to 30 minutes. Okay. Exclusively you can book my time. However, if my calendar is still free after 30 minutes and you have your queries still, then we can continue for even longer period also. Not a problem.
Yeah, sounds good.
Okay. Yeah. So any query, please don't hesitate in asking. Because nobody is a champion here. Even I make mistakes. And I apologize when I make mistakes. So at least, one thing is for sure that I will not teach you anything wrong. If I think I am confused or there is any, because it can always happen. I've been teaching for past many years, but there are all sorts of students. Big brains are coming in my classes. So sometimes it has happened that, I do not know the answer of a question. So then I want my participants to have patience. I come back to the answer either on the WhatsApp group or in the next session with illustration. Okay. So that's not a problem at all. Okay, now about the LMS. All of you have access to the LMS?
Yes.
Yes.
No issues?
Yes.
Yes.
Okay. So now what will happen that on a monthly basis, okay, because our payment cycle is also monthly. So the LMS access, whatever we are planning to cover in a month period, all that access will be given to you on the last day of the month. So once the next month's amount is confirmed, then we will again give you access to the LMS. So that's kind of a re-registration or re-access which is given on a monthly basis, right? So that much content will be available for your viewing and for your problem solving. So multiple choice questions and your task-based simulations. For task-based simulations, I will release the access when I have taught you that particular topic, because the participants at times, they have wasted a lot of time in only trying to solve the task-based simulations, and they end up saying that, I wasted about more than an hour and I got nothing out of it. Okay, because sometimes the task-based simulation takes really long time. So I will tell you that, okay, we are done with this topic. Now please do the task-based simulation. So many task-based simulations you can easily do. Okay, so this will help you all save your time, which is really important here. Now let me just share the screen. Just hold on for a second. Okay. Indu, is there anything that you want to say?
No, I'm fine.
Okay. Are you all able to see the LMS?
Yeah.
Yes,
Yes.
ma'am.
Visible?
Yes.
Yes.
Have you all seen it at home
Yes. Yes.
after the
Yes.
access
Yes.
was given?
Yes, ma'am.
Yes.
Yeah.
Okay. It's a simple LMS, okay?
Mm-hmm.
So the idea is to give you the entire content, and this content is, the base, the flow would be, because many of you have Becker with you, right? So all those who are studying from Becker, they will be able to relate the flow. This is how I'm going to follow the topics. So we'll start from the first chapter, module 1, which is today's agenda, balance sheet, income statement, and comprehensive income. Then the module 2 is EPS and public company reporting topics, wherein your different sorts of forms that are filed with your SCC and all, those forms and the reporting, the annual reporting that goes along, or the quarterly reporting, for the US companies and also for the foreign companies. All those topics will be covered here. Also, the earning per share part, it starts from module 2. Okay. Then we have in module 3 and module 4, the stockholders' equity. So the stockholders' equity is basically nothing but the extension of what goes in the balance sheet. So all these are basically related part. Now EPS is also related. Why? Because it is only after the income statement that you get to calculate your EPS. So this is what is going to remain the flow, and about 3 to 4 classes I will take to finish all this, because this is the base of our accounts or finance understanding here. Okay. These are the little mnemonics that you will need to go through yourself. I am focusing only on the concepts, and this is, something like mugging up the concepts. So I'm not very keen on mugging up. Rather, I will tell you what's there in the balance sheet, the income statement, what all things are required to make the financial statements, which the requirement of your SEC and all. So all those 5 elements will be taught to you in great detail. So I really don't think that basic, which is the mnemonic here, which is required for the financial statements, you'll need to even remember. Some mnemonics are really, really important. Okay. So those I will focus on. Like, for example, for OCI, what you need to remember, the mnemonic is PUF, because these are the 4 components that are required that make up the elements of other comprehensive income. So when we reach there, I will help you out with this. The rest of the things you can go through. Anything really troubling you, you can read through. Now this is, okay. Now this is the basic balance sheet, okay, that we will need to begin with. Now there is an entity called ABC Incorporation. Now if you look at the period which is mentioned here, okay, Sumanta, is this what is mentioned here and highlighted by me? Can you see this?
Yes. Yes.
Okay. Now, what is the difference? You must have seen the financial statements, if not of a US company, then at least an Indian company. Somewhere you
Yes.
must have seen the financials, right?
Mm.
Right?
Yes. Yes.
So, what do you think is the first difference? Because I've highlighted here the time period
Mm.
between balance sheet and income statement.
Balance sheet
Anyone?
and income statement. Income statement is for the period, and it is the financial position of a specific on a specific date, as of.
What? Income statement?
No, balance sheet. Balance sheet is as of the financial position, but income statement is of a period that is for 1 year.
Okay. Payal, is he right? Your group leader?
Yes, ma'am. Income statement is for the period and balance sheet is for on a particular date.
On a particular date at a particular time. Okay.
Times.
So, very nice. All of you will agree what Sumanta and Payal have just said. So, when we are looking at the balance sheet is on a particular date at that particular time. what is the financial position of the entity? Okay, where does this stand? So we have assets here. I know this format is a bit different format than what you have seen here in India because it is interchanged. Okay, so here in India, we have assets here instead. Let me just see. We have assets here on this side, at least in case of the old companies, when the format used to be different. So assets here and liabilities here. Here it is a different format. Now, so far as the format and the content is concerned, we have to study regulation S6, okay, for the SEC, for the issuers. And also in FAS, accounting standard codification, they have mentioned specifically what all components should be there in the balance sheet. Okay, so each of those components have to be studied in great detail here. Here we are starting from the balance sheet, starting with the very first thing. Now, I will first give you a high level overview of all the financial statements. Like the balance sheet is there, like the income statement is there, and your comprehensive income is there. Other than this, we also have SOCI, which is stockholders' equity. Okay, so the changes in the stockholders' equity. All those will be covered in later, module 3 and 4. And the last part of the income of the financial statements is your cash flow statement. So because we are following the flow with which most of the participants are comfortable with, cash flow will be covered only at a later point. Okay, not here I'm covering, although that forms an integral part of the financial statements. So starting with assets, this is a classic example of a classified balance sheet. What is a classified balance sheet? Anyone? Look at the balance sheet. What do you think is a classified balance sheet? Classified balance sheet means classification. Between what? Between your current assets and current liabilities and your non-current assets and your non-current liabilities. Okay. So when I talk about the current assets, Indu, what is the difference between current and non-current?
Like current assets and fixed assets both are there, right? So current assets basically the cash and cash equivalent kind of a stuff which keeps changing on daily basis. You can say accounts receivable, how much is the available there. But fixed assets are completely fixed, that once you invested you depreciate those, and that's the difference in the fixed and current. Like
And what about the liabilities? Current and non-current?
liabilities, yeah, like current liabilities are the accounts payable and interest payable, which you are doing the currently you
Okay.
have to pay like every month or recurring basis and everything, like kind of an expenses you can say, which is the liabilities of your regular basis.
So any
Not the
threshold when we say, any threshold when we say that you have to pay on a current basis, what is the definition of current?
Current, it's
Can I have Sarthak? Sarthak,
Yeah.
what is the difference between current and non-current? Because this is an example of a classified balance sheet.
For current asset, we expect the asset to convert into cash either
Please be
within 1
louder,
year.
Sarthak.
Okay.
Yeah.
Current asset means that the resources are expected to be converted into cash within either 1 year or the one operating cycle, whichever is longer.
Okay. Yes, Indu. So basically, that's the definition. Okay. So what we generally look at, even if I do not talk about the operating cycle, because we still have to learn how to calculate the operating cycle when we reach to the ratios part. But in most of the enterprises where they find it a little bit difficult, or because of the seasonal nature of the industry, it is not really possible to calculate the operating cycle immediately. We look at the next 12 months period. Okay. So if I'm talking about the liabilities, so any liabilities that are due for payment within next 12 months
12
from
months.
the balance sheet date. So if my balance sheet date is 31st December year 1, so this means that if any amount I will be required to pay to the outsiders before next 31st December year 2.
Year 2.
I will show it to my stakeholders under the current liabilities portion. This is for my stakeholders to understand what is the current position of my entity, how much immediate cash is really required in next 1 year period to pay off these liabilities. And if any amount is to be paid to the outside creditors after 12 months period, I will group all of that under the long-term liabilities. Like, for example, bond payable. So bond payable is a classic example of long-term liabilities, because if the entity has issued bonds, this means that the entity has borrowed money, okay, from various investors outside. Now, these various investors have given money to me and have their interest in the entity. How? Because they will now be entitled to receive interest on a yearly basis, or in US, it is semi-annually basis, okay, semi-annual basis. So on a semi-annual or an annual basis, I will pay all my investors who have taken bonds from me and have given me money. So they will be entitled to interest, and I will give them principal amount after 10 years. So during this entire 10 years period, I will pay them interest. And at the end of the 10th year, I will pay them one principal amount that they are paying me today. Okay, so this is nothing but the loan that I have taken from those people. As the bank gives us loan, so here these investors have given loan to this entity. The interest which I have to pay on a yearly basis to these investors, whatever is due for payment in next 12 months period, I think this will not work here. So whatever is due for payment in the next 12 months period, all of that will be covered under current portion of the long-term debt. Okay, or my interest basically, which is payable over the period of next 12 months, only that portion comes out and stands here as current liability. The rest of the amount stands here as bond payable, my principal amount, which is payable after 10 years, or the interest which is due for payment after 12 months period. Okay, so this we will all understand when we do bond accounting, which is very much part of your syllabus here. Okay, so salaries that are payable to my staff, of course, yes, it is, they will not wait for 12 months period to be paid. So this comes under the category of current liabilities. Even unearned revenue. So unearned revenue is something that you will understand under the revenue recognition. Okay, so this we will learn. A part of it I've already covered in the previous demo session, but in detail we will learn about this now. Similarly, accounts payable. Now these are nothing but your normal trade payables. Okay, so any portion of money which is payable to the outside creditor over the next 2 months or 3 months period, that will be covered here. Similarly, my notes payable, I have made a promise to somebody that I will give you some amount of money, like a promissory note, right? So you promise to pay the other party. So those are all your notes payable. Now interest payable, this is part maybe from coming from the bonds, or maybe some other borrowings that you have taken from a financial institution. All those things will be clubbed here under interest payable. But again, remember, this has to be paid only and only within next 12 months period. If there is any amount which is payable for after more than 12 months, then it will not be part of your current liability. It comes under your long-term liabilities. You can also call it non-current liabilities. So the standard does not give you any fixed terminology for any account that you create. Okay, it completely depends on the entity's management, how they want it, as long as the management does not get confused itself. Okay, so now against these liabilities, we have current assets. As Indu has rightly mentioned that yes, in the current assets, we have cash and cash equivalent. The definition is that, you know, this amount is immediately available for spending with the company. So that's why we calculate different ratios. different ratios like current ratios. In the current ratios, we have current assets and current liabilities. And the current ratio will basically help the shareholders or the other stakeholders understand. Okay, maybe those who have given me money, the bondholders of the entity, they will know that if any amount is due to us from the company in the next 12 months, do they have enough money standing here in their current assets, be in the form of cash and cash equivalents, be in the form of the trading securities. Trading security means that these are the equity securities that, or the debt securities that is immediately available for selling in the market. They can immediately sell it. It is highly liquid. And the entity does not intend to hold it for a long period. So do they have enough provision to make the payment that is going to be due to us in the next 12 months period or not? That's why this current liabilities and current asset comparison becomes extremely important in the eyes of the shareholders. And this is how we are supposed to look at the financials. Okay, so there is no mugging up really needed. Now, this is what the trading securities is. I've already explained to you. So wherever you come across this term, fair value, do not get confused. Fair value is nothing but the market value. However, there is, yes, a definition which is given by the accounting standards. But for the purpose of your conceptual understanding, what is most important is that, you know, whatever assets that we are talking about, or if there is a liability that you want to dispose of, that you want to get rid of, is it basically what is the market value of it? So how much are the buyers willing to pay for these securities in the market on the date when you are trying to sell it? So that makes it the fair value of any asset or any liability also for that matter. You will see when you do bond accounting, the fair value in case of bonds is also calculated. Okay. So then we have your accounts receivable. We know that account receivable is presented net. Okay. Now, what is the meaning of net? What is the meaning of accounts receivable pile? If I replace it with trade receivable, okay, let me just replace accounts receivable with an easier term called trade receivable. And I write net against it.
Net means some of the accounts receivable we will not receive. It will be there will be some bad debts and all. Some of the from some of the debtors we will not receive the money. So we will show as in the balance sheet as the net. That is the proportion which we are not receiving, that we will deduct, and we will show the net accounts receivable.
So why do you think, yes, Payal, correct? Your understanding is absolutely right. But why do you think, Payal, that, you know, it should be shown, this is basically called the net realizable value, NRV. Okay.
Yes.
So why do you think my trade receivables should not be shown at the gross amount and and they should be shown rather at the net amount or NRV?
So that it means our balance sheet reflects the true financial position, because if we show at gross amount, then some portions we will not receive. So so it is not showing the fair position of the balance sheet.
Absolutely right. Why? Because the intention is that the current liabilities or the portion which is outstanding here, so these people should know that how much amount can we expect from the entity in the next 12 months, that the liquid amount which is available to pay off the current liabilities. If I write here gross, which means that there might be some amount which may not be even received by the entity. If they are showing some amount which they do not expect to receive, that means it has absolutely no significance so far as the current liability holders are concerned. Right? And it is not only for the current liability holders, it is also for others who have given you money. They also rely heavily on this amount. Why? Because this is coming from your core business. Most of the cases that you will see, the sale will not be cash sale. It will be your credit sale. Now, if it is credit sale and you do not expect your debtors to pay you, okay, within next 12 months So the most of the times the time period is about 3 to 4 months. So if you do not expect your debtors to make the payment within the reasonable time, that means this amount is not basically your sale. And in such cases, it should not be shown on the balance sheet as your gross amount. So therefore, please make a note of it. Wherever you see the trade receivables or your accounts receivable, the presentation is always NRV or the net realizable. As we have the notes payable here, you all can hear me. It shows me internet connection is unstable. Am I audible?
Yes,
Yeah, sometimes it is breaking. Yeah.
It is breaking sometimes.
sometimes.
Very less, sometimes very less. Very
Okay.
infrequent.
Well,
Yeah.
I feel, more comfortable with the PowerPoint presentation because at least I'm able to write here. Okay. So on a book, it becomes a little bit difficult. So, but the note receivables again, how we have the note payable here, that means you have made a promise to somebody else to make the payment. Here you have received this promise from somebody else that he will pay you or the other entity will make the payment within next 12 months. That's why it is standing in the current assets category. What about inventory? Okay, so my dear friend Kavya will tell me. What about inventory? Number one, what is inventory? It is just a high level view of what we are going to cover in the next few sessions. So let's just acquainted with the terms here. Yes, Kavya.
Inventory is a stock.
Inventory is the stock. And how do you value it?
Uh,
One
on
line
the
for
basis
inventory.
of COGS, I think.
On the basis of COGS. Okay.
That is
Sanjay,
cost of goods sold.
I understand. Yeah. Yes, Sanjay. Sanjay.
Yeah. So what is the question? So inventory is a
Sanjay.
stock, right?
Not fair. Okay. So I will anyway repeat the question. Okay. So number one is I asked Kavya, what is inventory? So he told me this is the stock. So, okay, fine. This is the stock lying in my godown. This is the stock of finished goods available for sale. Right, Kavya? Kavya?
Yes.
Right? Okay. Now, my second question to him was, how do you value inventory? In one line or in one word, rather, you can answer this question. Inventory is, you can relate Payal. How do you value inventory? You just answered me about trade receivables.
Yes. So
Okay.
inventory.
Now, what about inventory? How do you value inventory? How do you think? Your logical brain, what does this say? How should your inventory be valued? You have given some loan to an entity, okay? And that entity has given you a picture that, okay, this is what we have. The loan is due in next 12 months time, maybe after 6 months. So the entity has given you a picture that say we have cash equivalent to this amount. We have trading securities that we can immediately sell in the market. This is my investment, okay? Then I have my debtors outstanding and these debtors are going to make the payment to me in next 3 months time. So then I have few promissory notes also signed by people. I can give them and they will give me this money. Then I have inventory. Sumanta, why are you raising your hand? Let me just finish. Okay. Now I have inventory here. Now my inventory's value is 100,000 rupees or dollars, let me say. My inventory value is $100,000. Okay. Now you're very happy because you think that the entity has enough inventory. If tomorrow they do not pay me money, I have signed a contract with the entity that I can take their inventory. They have hypothecated it and I can sell it in the market for $100,000. I've given them loan only for $25,000. So I'm in a better position. But when you actually took the inventory from the entity and you sold it in the market, you were able to fetch only $10,000. So the amount that they had mentioned here, $100,000, was nowhere close to the actual market value of that inventory on that date. There was a difference of $90,000. So you were not able to get your loan paid by using this inventory, which was hypothecated. Fine. So therefore, what you need to see here is that whether the inventory has been written here at the cost, because they said that, sir, this is the cost at which we have manufactured the inventory. $100,000 is my cost of manufacturing, and I have used all rules of management accounting to determine the cost of inventory. So hence $100,000 is my cost, and this is what is represented here. But when you try to sell it tomorrow in the market because you are able to get only $10,000, this means that 100,000 is absolutely irrelevant for the creditors, for the other stakeholders. Okay, because what they want to know is the true market value of this inventory on the balance sheet date. Hence, as we do for the trade receivables, the net amount, for the inventory also on the balance sheet date, we take the lower of the cost or the net realizable value. So even if your cost is say $100,000 here, but if tomorrow you try to sell this same inventory and you are able to get $10,000, the lower of your own manufacturing cost or your market value will be the true value of your inventory. So always remember, the current assets is the most important item here. Okay, and therefore in most such cases, as close to the market value the items are mentioned. Forget about the prepaid expenses, because this is the amount that you have already paid in advance. Okay, and now you will only get your services done. So you will not get paid money instead. So this is not your money. So the most of the times, the outside stakeholders or the creditors are unconcerned with the prepaid expenses. Okay, so far as the current assets are concerned, the most important logic to be kept in mind is that it has to be as close to the market value as possible. Okay, so one logic to understand. Then we have certain investments. Certain investments are available for sale securities, held to maturity securities, and investment in affiliates. Now, these are the debt securities. Now, when I say debt securities, what is the meaning, Sarthak? These are the investments that the entity has made. And these are the non-current investments, because the current investment in securities is already classified under the current assets. These are the non-current investments of the entity. If you want, you can just write non-current investments. Sarthak, are you able to hear me, dear?
Yeah.
Okay. Now, what was my question, Sarthak? I've forgotten.
Debt securities.
Sorry? Debt security. Yes.
These are the tradable financial instruments that are borrowed and have to be repaid by a company.
Financial instruments.
Yeah.
What is the meaning of financial instruments?
I'm not very sure about this.
Okay. So, yes, you are right. It is a financial instrument. But then, Sarthak, if I invest in equity security, which means that if I purchase equity shares, common stock in some other entity, is that not a financial instrument? That's also a financial instrument. So I don't want to confuse you a lot with this term called financial instrument, because it's a deep topic and we are going to read this. But, after a substantial portion has been already covered here. Now, debt security. this is really important to understand here at this point is that equity security means that your investment is happening either in the common stock or basically you are investing in the preference shares of some other entity. Okay, so the stock of any entity that you are purchasing. Debt security means that you have lent money to some other entity. So that means you are the holder of bonds. Okay, so in this case, the company has borrowed money from certain investors. Let me just open my PowerPoint presentation. Okay, please hold on for a second so that I can take you all to the PowerPoint presentation. And I will be able to, okay. Please hold on for a second, okay. This is May 9. Sumanta?
Yes.
Sumanta?
Yes. Yes, ma'am.
समझ में आ रहा है? सुनाई दे रहा है?
Yes, yes.
Okay. All right. See, I'm most comfortable with the PowerPoint. Okay. Let me just share this. Okay. Are you all able to see this? My blank screen?
Loading. Yes, blank screen.
Yes, blank screen.
दिख रहा है ना? Everyone can see this?
Yeah.
Okay. Now, when I talk about investments, okay. So what happens in case of investments? There are two types of investments basically that we will study. I am giving you a high level idea. Why? Because we are starting with the balance sheet. So in the balance sheet, all these components are important. Okay. So when you do your multiple choice questions, there will be questions asking you what these are the components that are there. Now, sum all the current liabilities together, or sum up all the current assets together, or they might even ask you this ratio of current assets and current liabilities. Okay, so that's why all of this is important. And because in investments we have certain investments that come in the category of current assets, it is important to understand this part here itself. Okay, although we are going to understand in greater detail when we reach to the financial instruments chapter. Okay, now so we have certain investments and equity, or these investments these investments could also be in debt securities. Okay, so here you are acting as an investor. So this means that you have purchased or you have invested in shares of any entity, shares or stock. This could be your common stock, which means your equity, or this could be your preference stock. Okay. Now, when I talk in greater detail about the preference stock, then you will realize that not in all cases your preference stock which the entity has issued will be categorized under your stock category. Sometimes it becomes your liabilities. Now, this is the changed accounting. Okay. But for the time being, only simple concepts first, your equity investments. Okay. Now, in most such cases, wherever you talk about the equity investments, this will be under the current asset category. So whenever they give you any question and ask you to sum up or what is the total of the current assets, unless any other information is provided to you, the assumption will always be that the investment in the equity securities will only and only be valued at fair value, which is nothing but the market value, and it will be under the category of current assets. However, the entities have a choice because of either taking it to the current assets, or if they want, they can present it under the non-current asset category also. If that happens on the question, they will specifically tell you that this is what the entity has chosen. By default, it is always the current asset category. Now, what are the debt securities? Debt security means that you have invested or you have lent money to some entity. That means you are acting as bank and you have given your money to some other party. Now, in return, what will you get? They will issue either bonds or they can also issue debentures. All of you are aware with these terms? So not necessarily. If you are looking at bonds, this means that this will become your liability, or always your debentures will be your liability. If you have given money to the other entity and they have issued you bonds or debentures, this means that you are the investor of a debt security. Now, these debt securities may be categorized in one of the three categories. I am not going to talk in greater detail about these categories, but these are called as either trading securities, or these are called as available for sale securities, or they are also called as held till maturity. Okay, now without mugging up, logically, Lohit, do you want to tell me that what is the meaning of a trading or available for sale or held till maturity? Let's say, for example, bond. You have purchased bonds of an entity, okay? And the value of those bonds is, let's say, for example, $10 lakh, okay? To this entity, you have given so much. Now you tell me, if your intention is to hold it only for a very short period of time, as soon as the market value gets better, there are people who are willing to buy it for a price higher than 10 lakh. I am willing to sell it off. What do you think? Just by logic, I have not explained you anything yet. But only by reading these terms, what do you think is the category where you should place it?
Under current assets?
Yeah. So that means, are you talking about the trading securities?
Yeah.
Yes. Trading security. Logic. Trading means it is ready for trading. Trade karna hai. I want to trade in this security today. As soon as the market value improves, I will sell it off. Okay. Now, Lohit, if I say that no, my purpose is not to find a ready buyer for this. I have invested, I have given money, lent money to this entity called ABC, but I'm going to hold it for next 10 years because the bond will mature in next 10 years. And my intention is to earn interest on this bond for next 10 years. And after 10 years, at the time of bond maturity, because these bonds, these debt securities, they always have a maturity date. Unlike my equity security, which has no maturity. We all know this very well. The equity shares don't mature. They only give you income either in the form of dividends or your capital appreciation. You all agree? Do you all agree? There is
Yeah.
no maturity
Yes.
date so far
Yes.
as your stock is concerned. But
Right.
in case of your bonds and debentures, yes, there is a maturity date.
Maturity.
If you have given money to the other party, it is not forever. So you
Right.
would say that after 10 years, I need my principal back. But for these 10 years, you keep paying me interest at whatever rate we have agreed. Right?
Mm-hmm.
So that
Right.
means my intention is to hold it till maturity.
Maturity.
Maturity is happening after 10 years. Even if there is a capital appreciation that I see, I'm not going to sell it because my intention is something else. So Lohit, if that is what my intention is, that I want to make money in the form of interest over next 10 years and get paid at the time of bond maturity, what do you think should be the most suitable category, or is the most suitable category for this kind of an investment that I've made in this bond?
Non-current asset. I would be categorizing under non-current assets.
Non-current asset, and also under the
Interest.
non-current asset, held till maturity category is the most suitable, because I'm going to hold it till maturity. Correct? And the maturity would not normally happen immediately. However, if my bond is maturing in next 12 months, then I have to change the category. Right or
Yes.
not? Then it
Yes.
changes.
Yeah.
Now, for
Then
example, there is a security or my investment in a bond which does not fit in either of these two categories, which means that I'm a little bit dicey. I'm not really sure if I want to sell it. But yes, if there is a real good capital appreciation happening, or if, I see the market not doing very well, and I see that, if I hold it in future, the entity may not be able to make the payment to me, then I have this middle category, which is called as available for sale, but neither trading nor held for maturity. This is my bond investment or my debt security investment. Always remember the difference between the equity investment, which has no maturity date, but a debt security, okay, always has a maturity date. And this maturity date, whether you want to hold it till that date or whether you do not want to hold it till that date, you are not interested in earning interest, you are only interested in the capital appreciation, then your trading security. If in between anything goes wrong, or I need immediate cash because there is a capital project that has come up, then okay, put it in the available for sale security. Now, in most such cases, the entities have a choice for trading and available for sale securities. If you want, you can put it in the current. If you want, you can put it in the non-current asset also. So by default, your trading security, just like your equity, this will also be in your current asset category. Available for sale security also, it could be your current, it could be your non-current. Why? Because you are not sure for how long do you really want to keep it. But held to maturity category has to be a non-current. And the valuation of this, or the accounting part of this, is extremely interesting to study. And this is called as, or it is based on amortization. So once you learn this amortization, how we make this amortization table and all, once you understand what is effective interest rate, what the financial institutions are doing, or if somebody, anyone has taken a loan, then you'll be able to understand how they are basically splitting between the principal and the interest, how they are calculating all that. Okay. So all that part becomes really very well understood. So once you have learned about this debt security and held till maturity amortization method, the same is applicable when these debt securities are issued by the other party. That means in the hands of the borrower who has presented this as his liability. So one accounting that you learn from the investor standpoint, for the bonds, the same accounting will be applicable in case of the liabilities also, where the bonds are issued, because it is based on the same fair market value calculation. Okay. It will take a bit of time when we do the lease accounting, when we do the income taxes and all. That time we will also study about the bond accounting. Till now, everything clear? I know a lot of mess on my paper here on the sheet that you all are seeing. But
I
have
have
you
a
all?
question.
Yeah.
Sorry to interrupt you. You said like AFS and this trading securities. This is our choice whether we wants to put it as a current assets or we wants to put it as a long term.
Hmm.
So how do we need to do the declaration that we are using this one? Suppose we say okay, we're gonna sell it in within 12 months, but we couldn't sell it, or maybe some other reason has happened, and we will not make the sale. Then what, is there any penalty that you said that this is a current assets, but
There is no
it's
penalty. It is only a disclosure in the notes which is needed.
Okay, in the notes, right? So
In the
there should be
notes,
some
you only
disclosure.
disclose.
Okay. Okay.
Okay. So reclassification is also possible.
Uh-huh.
So from one category, you can go over to the other category. With all that reclassification, elaborate note disclosure is what is needed.
Okay, just the disclosure is needed.
Yes.
Okay.
Okay. And because the reclassification is happening, so you first have to give the financial effect of it, whatever the effect of it is going in the income statement or in the OCI, that has to be shown. And then in the
Right.
notes, the reason for this reclassification, because it is not easily done. So
Right.
in most of the cases, once it is classified in a category, should always remain unless there is a big change which is asking for this reclassification.
Okay.
Yeah. Any other questions here? Can I come back to the LMS? Sumanta?
Yes.
Yes. Yes, please.
Understood? So
Yeah.
now these points will be easily understood, right? So I have invested available for sale securities at fair value, right? The debt securities and held to maturity securities. That means I want to hold these securities till they basically mature. Okay. So therefore, for the world to know that I do not have this money for immediate disposal. Even if there is any liability which is outstanding in the next 12 months, please do not include this. Now, investment in affiliates, what does this mean? Harshit. Harshit,
Yes, ma'am.
I
Hello,
know you are taking a
am I
demo
audible?
session, but Bhavna does not spare anyone. Yeah.
Sure, ma'am.
Yes.
Yes.
Okay. Investment in affiliates.
Okay.
What is the meaning? So basically, you have made some
It's
investments. Yeah. Please go on.
in some other company.
Sorry.
We have made some investment in other companies,
Can't
and
hear you.
okay, just a minute.
Coughing. Okay, not a problem. So anyone else who wants to take this file, do you want to take this question?
No, ma'am, I would be answering.
Okay.
Investment in affiliates is nothing but investments we have done in some other companies,
Correct.
or mostly in affiliates. It means that it's a part of a company. Like there is a parent company, and we have companies beneath that. So investment on those companies also considered as investment in affiliates.
Correct. Do you all endorse his answer?
Yes.
Yes.
So now
Yes.
we have fixed assets. Now we have property, plant and equipment, right? All of us are comfortable with the fixed asset. And how are fixed assets valued and why are these fixed assets valued in whatever answer you are going to give me? Because I know all of you understand the valuation of your fixed assets or the property, plant and equipment. Right? Lohit, how do you value plant, property and equipment in your entity?
Market value.
Really?
Yeah.
What is the purpose of property, plant and equipment, Lohit? Is this same as holding cash? Or is this same as holding my trading securities at fair value? The purpose. Let's understand the purpose because you know what? We will talk about each of these topics in greater detail. We will understand how the valuation is done. But here today, we are only discussing why this valuation is done in that certain manner. Okay, because valuation, how it is done is that needs elaborate calculation. We are not doing any calculation today. But why and how is this presented on the balance sheet? What is the logic behind that presentation is what we need to understand. So, Lohit, do you think that the purpose of the purpose, how and why you presented property, plant and equipment on the balance sheet is the same as your trading securities purpose,
No,
which is
like
at fair value?
no. I think we will show it at a historical cost with all.
देखो Google मत करना.
No.
हाँ.
So
Okay.
including all the acquisition cost associated with it.
Okay. All right. So why at the historical cost? I think fair value is the right way. Sarthak,
Yeah,
what do you think?
I think because of a going concern concept and prudence, we are valuing it at a historical cost because we have to show a lesser profit conservatism.
तुम तो बहुत आगे निकल गए. अच्छा. And Sanjay,
It's
is that saying
basically
something?
based.
Do we agree?
No, so basically, property, plant, and equipment is used for producing goods, and then like the value of the machine or value of the equipment like decreases. So we take the depreciation and then we show the cost. Yeah.
Okay. Sumanta?
Yeah, so property, plant, and equipment has a useful life. So once the life passes, it gets depreciated. So it has to be done on a carrying value or a book value.
Okay. So mostly if I combine all your answers, yes, looks like that the answer is correct. Okay. So if I want to talk about it in one line, I will only say that the purpose why I have invested in property, plant and equipment is because I want to keep it with me for the purpose of production for next few years so that I'm able to produce goods, which is the core purpose of my business, and generate revenue. Now, because I do not intend to sell it in near future, the purpose, the intention of investment is not to earn money by selling it. I have not purchased or I have not invested in this for the purpose of capital appreciation. Rather, the purpose of investment was to use it for the purpose of production over next few years and then earn revenue from the goods that are sold. That's why there is no point in showing it at the market value or the fair value. Unlike my other items, like say, for example, trading securities, here the purpose is to immediately sell it in the market as soon as I'm able to find the right buyer of my product. Had the intention been the same here, I would have done the same here also. But because I do not want to overvalue any items, right? Overvaluation is bad. It distorts the entire financial picture of my entity. It does not present a true and fair view of the financial position of my entity. Therefore, I keep checking the market value of these items. Why is that market value check required? This is not required on an annual basis. Only when there are certain conditions that are present in the market that force me to think whether if I have to sell these equipments or property plant in the market tomorrow because I'm using them perhaps as collateral, because I've borrowed money using these items as collateral, the market value becomes important only in that particular circumstance. And if the conditions are such that force me to think that the market value might be lower than the historical cost of these property, plant and equipment, because I do not want to overvalue those items. Okay. Therefore, in such cases, I will tell you, this is an important concept that we are going to cover in my discontinued operation part also. Okay. Now what happens is I am holding property, plant and equipment. See, these are all the concepts that we have to understand. Okay. Property, plant and equipment. Now, the property, plant and equipment I bought today. Okay. And Sumanta, when I bought this, I paid $100,000. Okay.
Okay.
What is the journal entry that I've passed today?
Is property, plant and equipment account debit to bank or cash account?
Yes, because I've paid that amount, hence I've credited my bank, right? Now what happens is, because I'm going to use it for another few years for the purpose of production, therefore I will only depreciate it using, let's say, for example, straight line method, right? Let's say for 10 years, that's the useful life, which is estimated. The word is estimated. So
Yes.
every single year, $10,000 is what I will charge from my income statement. Payal, what is the journal entry that I passed for charging depreciation? Number one, Payal will answer me this. And also, Payal will tell me why depreciation. Why do I depreciate? So number one is the journal entry that all of us know for depreciation. And please, my class, do not Google anything. If you start Googling, you will lose all your focus. These are the concepts. Okay. Now, journal entry. I know this is very simple. All of us know this. Okay. But just in case anybody does not or has forgotten it, okay, there is a possibility. Then don't hesitate in asking. Number one is the journal entry, and number two, why depreciation?
Journal entry will be depreciation account debited to accumulated depreciation account.
Indu, is she correct?
Depreciation to accumulated depreciation
Yes.
account.
To accumulated depreciation. This is the journal entry that Payal has given. Payal, you have not credited property, plant and equipment
Property,
yet?
plant and equipment. Yeah.
Yeah, I have not credited it because in the in the balance sheet we will show as property, plant and equipment as the gross value less the accumulated depreciation, and then we will derive in the net value. That's why I have not credited the property, plant and equipment.
Absolutely correct. Absolutely correct. Okay. So now we do not credit the property, plant and equipment. Why? Because on the balance sheet, what we show first as the gross amount, which is $100,000, and then the accumulated depreciation, which is nothing but my contra asset account. This is a credit. So ideally,
Correct.
every credit should be transferred to the liability. There are only two possibilities for a credit. Either you transfer it to the liability, or your credit should be shown as your revenue on an
Right.
income statement. So this definitely we rule it out. So is this a liability? No. So this means this is treated as my contra asset. Contra asset means it reduces the value of asset. It reduces the value of my asset. This is the meaning of contra asset. Similarly, as we do in case of the accumulated depreciation, Payal has earlier said that we reduce the bad debts. So instead of bad debts, the right term is provision for bad debts. That is also considered as contra asset. Contra asset means this reduces the value of my trade receivable, which is shown on the balance sheet. So trade receivable gross less provision for depreciation, what you finally get is the net realizable or the net value. Similarly here, from the gross, you reduce your accumulated depreciation of 10,000 for the first year, and then every subsequent year, this value keeps increasing because every single year you keep passing this 10,000 entry. So in this particular first year, the value of the fixed asset is 90,000. This is nothing but the $90,000 is called as the carrying value of my property, plant and equipment after depreciation when on December 31st, year one. Right?
Yes, ma'am.
Right.
Now what happened? Okay. This why has to be answered. Payal, okay? Don't Google
Yes.
it. You have to
No.
answer it later. Let me finish
Okay.
up with one concept first, and then we will come to why depreciation. Why depreciation is important, basically. So the carrying value on the date, according to my books or my calculation, is 90,000. But what happened all of a sudden? This equipment that I have purchased, okay, now I am not able to use this equipment at all. Or I am seeing that, see, others in the market have really better equipments than the one that I have bought, and they will be able to manufacture at much faster rate more number of products. Let me just sell it in the market. In my books, this equipment is appearing at 90,000. Today, when I'm trying to sell it, why? Because more advanced technology equipments, better equipments are available. Okay, so this entry was passed at the end of the year. This was on January 1 that I had bought. On December 31st, this depreciation entry was passed. So this January 1, this was the best equipment available. But by 31st December, the scenario changed. Chinese equipments better available. Okay, at much lesser price, they are able to produce more number of goods. Then let me just sell it in the market. So that means there is an indication that when I'm trying to sell this, or when I try to sell this equipment in the market, it will be very difficult for me to find buyers for $90,000, which is the carrying value of this equipment in my books. Why? Because there are equipments available at a lesser price, giving better value to the customers. So when I went to the market, I was not able to find any buyer for this. Then I decided, okay, let me just continue using my equipment like this only. Even if I'm not able to produce as much as other competitors are doing, but I do not have money. Let me continue using it for 90,000. Now, Payal, please tell me one thing. If this same equipment I'm trying to sell in the market, people are willing to pay me only $50,000. Should I still carry it in my books for 90,000 or for 50,000?
No, we will carry it for 90,000.
Lohit, what is your opinion?
Yeah, we will be carrying 90,000 only. I think once we sell that loss, we will be recording it. Till the
Right.
actual sale happens, we'll be carrying it at
No, there
90.
is no sale that has
Then
happened.
we will carry
On
it 90.
31st December, I had full indication. The conditions were prevalent that my equipment may not be able to fetch the carrying value which is mentioned on the balance sheet. So I went to the market and I figured out what is the true value. What is the fair value that the buyers today are willing to pay for my equipment valued at 90,000. I figured out that, oh, $40,000 loss. Should I book this loss of 40,000 or should I not book this loss of 40,000? Keeping two things in mind, the intention of my investment in the property, plant and equipment was to use this for the purpose of production for a longer period. But because others in the market are not giving me the carrying value of the product, should I reduce it to the current market value or not?
Since we have bought this equipment for long-term use, we don't have the intention, while buying, we did not have the intention of selling it in the near future. So I think that we will use that machinery for producing goods. So we will not sell it in the current time. So we will book it at 90,000 only for this time. Again, for the next year, we will charge depreciation like that till the machinery continues to give me is in usable state. When the machinery will not be in the usable state, at that time I will see the market value of that or the sale value of the equipment, and we will see the total net value till now, that is the carrying value, and then at that time I can consider that when it will not be in a useful state. But now also the machine is a good condition, so I will not sell it in the near future and I will not book the loss.
What is this term?
Impairment loss.
Impairment.
What is the meaning of impairment?
When the carrying value of the equipment is more than the book value of the equipment. Sorry, is more than the market value of the equipment, then it is impairment loss.
So why are we not booking this as loss? This is impairment loss. Now listen to me very carefully. In a usual scenario, we will ignore this decline. Okay. But if there is a strong indication that the balance sheet maker has, that the market value of the product has really gone down substantially, and this is like a permanent decline in the value that I'm seeing. Okay, now the scenario that I've quoted here looks like that there is a permanent decline and it is a substantial decline in the value. The conditions were present. The conditions present were that there are new equipments now available in the market. If that condition is not present at all, then I don't have to look into the market value of a property, plant and equipment item. Why? Because the intention is to only use it for a longer period of time to produce goods. But if there are conditions prevalent that indicate that your equipment might be impaired, you cannot ignore those conditions. Then you further start testing for impairment. That's called as testing for impairment. You test the equipment, you gather all the information from the market. Okay. If you finally reach, or your valuer, basically you will need to hire a valuer. If your valuer finally reaches to the conclusion that we have only people maximum can pay 50,000 in the market, that means, yes, my asset is impaired and I will have to book it at 40,000. This is called as impairment loss. When I book my impairment loss, what is the journal entry, Sarthak, which is passed in my books of accounts? Loss 40,000 because the conditions of impairment were prevalent. What is the journal entry, Sarthak?
Impairment loss debit to asset account.
To asset.
Yeah.
Yes. So my impairment loss file, do you agree with the entry that Sarthak has passed?
Yes, yes.
So my asset, property, plant and equipment going forward will be in the books shown at only 50,000 from next year onwards and not at 90,000. In a usual scenario, I am unconcerned. But if there are conditions that are present, I cannot ignore those conditions. So normally the entities do what? About 3 to 4 years or 5 years, depending on what sort of the fixed assets or the asset that they are talking about, they test it for impairment. They check whether, the conditions are present in the market or not. This would happen more frequently when you are using software. There are entities that are heavily dependent on softwares or IT, right? So in those cases, technology changes very fast and the value, okay, or particularly your intangible asset that you're holding, that value will change. Okay, so this has to be done when the conditions are present. Okay, all of us are good with this?
Yes.
Okay. Now, so that's only in those particular cases, the value is to be tested. Now this, in case of the operations that are going on, it is okay. Operations going on means continuous operations. There is no segment, there is no component of the entity, there is no product line, there is no geographical location which you are closing down or you are selling off. So that's called as your continuing operations. Okay, so in case your operations are continuing, then only and only look for the impairment stuff when there are conditions that are prevalent in the market that force you to look into what is the current ongoing market price of my product. If it is lower than, or the fair value anytime is lower than your carrying value, which is mentioned on the balance sheet, always pass that entry of impairment loss and book that loss. Okay, so then it becomes that loss of the period. This becomes the loss of the period in which the impairment has been identified. This goes to my income statement of the period in which the loss is identified. Correct? Otherwise, it is not needed.
So in this case also, do we need some appraisers documents to attach to prove that this is highly depreciated, like market value is very low, that's why we are impairing this, or just a disclosure?
Yes, a disclosure is needed because then you would have passed an entry in your income statement also. You would have booked
Right.
your impairment loss.
Impairment loss. Okay.
Right? So in that case, it is needed. So here, do you all see less accumulated depreciation? So this is exactly the same thing that our dear friend Payal was talking about, that your depreciation is a contra asset. So herein, all your historical cost value will be mentioned, or also called as your book value will be mentioned. And from this, you reduce your accumulated depreciation. So depreciation alone, okay, let me come back to the PowerPoint. So depreciation alone, just hold on for a second. Depreciation alone, when you pass this entry, depreciation expense, okay. Let's say, for example, I've passed this entry for $10,000 of depreciation expense, and I have credited my accumulated depreciation. So that means every single year, my accumulated depreciation will go up by 10,000. So this will reduce the book value of my asset, and this is a charge on the income statement for that particular period, for every single, for the period, right? So charge on income statement, right? Now, Payal, I was actually asking you very intelligently, you escaped that question, Payal, that why depreciation, Payal?
Because
Why should I not charge the entire amount of this $100,000 in which I have invested? You know, the amount that I've invested for the purchase of property, plant, and equipment or machinery. Why have I not passed this entry instead? My PP&E debit by $100,000. Why is this entry incorrect? These are the kind of questions you should get familiarized with, because they test you on such concepts. Okay. And to whatever, let's say I have too much of money in my bank account and I've just paid it off like this. Why do you think is this entry incorrect?
Because if we pass this entry, that means when we are buying the asset at that time, we are using the asset for suppose we are buying the asset for, we are thinking that the asset will have useful life of 10 years. So if so at the end of the 10 years, if I pass that entry PPE to bank account, then it will not show the correct value of the, it will not show the true financial position, because that value of that PPE we are using for 10 years. So it is so every year it is decreasing by 10,000. So if we in the last year only we are passing, so what will happen then? In the last year, our the financial statement will not look, it will not be correct, and also every year it will not be correct, because we are using it, we are using the asset for the entire 10 years. So this year, if we are using it, so suppose this year the machinery has the capability of producing 1 lakh goods. Next year it will have a capability of producing 90,000 goods. So we have to charge depreciation for this year to show the true financial position for that asset. And
okay, so when you are trying to relate the machinery cost with the number of goods that are produced, is there an accounting concept that defines this relationship?
matching.
What is matching concept? Sanjay? Sanjay?
So matching concept is basically for as an example, like revenue is should be like related with expenses, right? So cost of like goods sold should be associated with like your income.
Rajiv, I'm so sorry. I have not taken your name so far.
No
Okay,
problem,
I
ma'am.
was.
I have just joined, means
Oh,
10
you have
minutes.
just joined. Okay.
Yeah,
Okay.
actually, I was outside. So
Okay.
matching concept is basically to match the cost to the particular period. So if we are generating a number of goods through that particular asset, then that portion, that cost part of the asset should be uh, utilized in that particular revenue, right? So, for example, means if we have purchased, as I think Indu or someone has mentioned, if we have purchased asset which is approximately 10 years of life, so we should divide the entire asset cost in 10 years, and one portion means that particular year in which we are generating the revenue, we should utilize that cost in that particular statement, income statement. So 1/10 we should utilize as depreciation.
Okay. All of you agree with Rajiv?
Yes.
Even Sanjay?
Yes.
Sanjay,
Yes.
what he has said is correct or incorrect? Don't you think that this is actually the matching concept? That's the reason why we do not recognize or charge the entire amount of property, plant, and equipment in the year of purchase itself, because this is going to give me benefit over how many years? The benefit I am going to enjoy over a period of 10 years. Then why should only 1 year income statement take the entire burden of this 100,000 when I'm going to get the benefit of this over a period of 10 years? And this benefit is nothing but the revenue that I will generate by selling those goods that are produced by the use of this property, plant, and equipment. That's the benefit. So if I'm going to get the benefit over a period of 10 years, then the cost also should be split aligned with the benefit that I'm going to get over this period. This is the matching concept. And as Rajiv has correctly pointed out, and even Sanjay mentioned about the COGS thing, I think that's an excellent example of how you basically relate your revenue with the cost, because all the revenue that you generate from the sale of goods, the cost incurred to generate that revenue is standing in the form of your cost of goods sold. And only when that sale is credited should the COGS be debited on the income statement in that very same period. That's the matching concept. So this matching concept has various applications. One application is COGS, while another application is depreciation. There is yet another application of it that you will see in bond accounting. How you split basically your liability and your cost associated with that liability in the form of interest. So be it from the investor standpoint or be it from your issuer standpoint. Okay, so these are the various applications. So this answers why of depreciation. Okay, why do we depreciate the asset over the period of its useful life, and why not charge it to the income statement in the period of purchase itself? Okay, so this is, okay, you all can see my screen here, LMS?
Yes.
Yes, ma'am.
Yes.
Okay, so after this, we have my intangible assets. So we have for the intangible assets, goodwill is mentioned here. Most of the times in case of goodwill, when we do the business combination, okay, the consolidation method of accounting, that time we will read about the valuation of goodwill in greater detail. All right. So which is tested for impairment. Basically, goodwill is not amortized, but rest of the items that you see under the head of intangible assets called patents and all, they are shown net of amortization. How you basically show your fixed assets, the same way these are also presented. Okay, then we have your other assets. I am not touching this part at all. This is a complex accounting part. As we reach there, we will do it in greater detail. But for the time being, only understand that there are certain retirement liabilities, okay, that the entity has to pay. Now, these are the certain liabilities that the entity has to pay, but at times the entity, when it invests in certain investments and the investment value is more than the liability that the entity has to pay to cover the employee's cost of post-retirement, that comes in the category of your post-retirement benefit assets, okay, because then that is giving you asset or it is adding value to you. So likewise, we have deferred income tax liabilities here. Under the non-current liabilities, we have deferred income tax assets here. So you will understand, learn the valuation of this, how it is accounted. This basically is the result of your permanent, the temporary differences, okay, in the book and the income tax incomes, right? We have covered the liabilities part. Now what comes here is the stockholders' equity. Under the stockholders' equity, I told you already, module 3 and 4 will extensively cover this part. But let's have a high-level view of the items that are part of the stockholders' equity. So one is your capital stock. Capital stock means that, you know, these are the, this is the stock that the entity has issued. Always remember that whenever the entity has to raise its funds, okay, there are two ways to raise funds. Priyanka, are you here? Priyanka Babu Rao? Priyanka Babu Rao is here or not? Harshit is there. Okay, Harshit, you tell me one thing. What are the two ways the entity uses to, to raise its funds?
Can you please repeat the question again?
What are the two ways? Am I not audible clearly?
No, you are.
Some issue?
No,
Should I
no.
write it in the chat box?
No, it's fine.
Okay. What are the two ways the entity uses to raise its funds?
One could be through loans, and the
Okay.
second could be through, and the second could be by issuing shares.
Yeah, correct. So what is basically, or technically, what is this called? This is called as corporate finance, right?
Yes.
How does a corporate finance get financed? So corporate financing is two ways. I know my handwriting is like horrible here, but actually it is not very horrible. Okay.
No, it's good.
Sumanta, okay, then I can understand. Yours is even worse, huh?
The words, I even don't understand what I have written in the paper.
Okay, then at least somebody is there to appreciate my bad handwriting also. Okay. So there is one word for bad handwriting. You can write it down. That bad word is cacography. Good handwriting is called calligraphy. So, well, I do not write that bad on a piece of paper, but here it is very difficult to write actually. So, corporate finance, possible by two ways. One is that you issue your shares, equity capital, okay? Another one, as Harshit has said, that you can raise or borrow money. There are advantages, disadvantages of both, because this means that you have more shareholders. Shareholders means that they become your owners of the entity. Owners of the entity means that they need share. They need share in profits, and they get profits in the form of dividends. The company has no mandatory liability, no legal liability to pay dividends to any of the shareholders. It is not a legal obligation. It is not a liability until those dividends are declared by the management. So once it gets declared, then then those dividends that have been declared becomes the liability of the entity. Okay, and it is presented in the liability side until it is paid off by the entity. So the advantage is that if the company is going in liquidation, they are going to stand last in the queue to get paid off. They cannot demand the company any amount that they have given to the company because they are the owners of the entity. Okay, so you have to wait until all assets get disposed of. Pay off the outside creditors first, pay off the government dues first. If there is anything that remains, then it gets paid to the owners. What about the borrowers? The entity would say that, yes, I'm borrowing money, but this is a fixed cost that I'm adding. Even if I'm not able to generate enough income, I still have to pay the outside creditors. They are the borrowers. Okay, I'm the borrower. They are the lenders of money. So if you borrow from them, there is a fixed interest cost that has to be paid to them. But if your sale goes through roof, then you have just to pay the fixed cost, which is not going to increase after the interest has been paid off. Then whatever goes in the pocket of the money of the entity, that's the income of the entity and it does not go down. Okay, so therefore there are pros and cons of the different forms of corporate financing. So both of them are mentioned here on the balance sheet on two sides. Now when I look at the balance sheet, it give example, if I'm looking at the old form of my Indian balance sheet, wherein the assets were mentioned on one side and on the other side were liabilities and equity. Okay, I'm just drawing up the old balance sheet that most of us are aware of. Okay, the old balance sheet type. Just a minute. Let me just go down a little bit and then it'll be fine. Okay, so the old balance sheet. Sarthak,
Yes.
tell me one thing. What should I write here? Old Indian balance sheet that all of us are
Liabilities.
aware of. Here, on this
Yeah.
side,
On the left side,
assets. Here is what?
liabilities.
Equity and
Yeah.
liabilities. Right? So the first is your equity, capital. Okay? The second part is what? My liabilities. Right or not?
Yes.
Am I correct in my understanding? Payal, Lohit, Rajiv.
Yes, ma'am.
Yes, yes.
Yes, yes.
Now, Payal, what is the basic accounting equation that we have learned in our 11th and 12th?
Assets is equal to liabilities plus equity.
Okay, so you will find many exam questions, multiple choice questions based on this accounting equation. Okay, assets is equal to liabilities plus my equity.
Liquidity.
Does this match the balance sheet?
Yes.
Sumanta?
Yes, yes, absolutely.
It matches. Now can I
matches.
say that my equity is nothing but my net assets?
Yes.
How do you prove that?
Equal to asset minus liability. So whatever liabilities you pay off after that, whatever is remaining with you is your net asset.
Is your equity. So
Net
that
asset,
means,
net asset.
okay, so which means that if I have so many assets with me, I pay off liabilities, whatever remains, that's basically my equity or my net assets.
Net
Can I
asset,
therefore
yes.
say that the equity shareholders are the residual owners or they have the residual share in the net assets or in the assets of the entity?
Yes.
Remember this residual shares in the assets of the entity, because this is a very important concept that we are going to use in our financial instrument also. Many multiple choice questions, at least 1 to 2 multiple choice questions on your exam will be based on this accounting equation. I have participants coming to me telling me at the time of exam, we got confused in this accounting equation. This is such a simple equation, but when they give you some values, people are not able to understand and arrive at it. Always remember this old form of the balance sheet that most of us have seen in our lives during our practical work also. And in class 11th and 12th, this is what was taught originally. You will never ever go wrong. Good participants have told me that because there was shortage of time, we were reading through it and we got so much confused because we forgot the equation itself. Okay. So please remember this. Now, this is what exactly the portion that we are covering here. This is about the owner's share. This is the outside creditors who have to be paid first, and then whatever remains after paying off the outside creditors is the amount that remains with the company's owners. This could be in the form of preferred stock. Wherever the preferred stock is mentioned, they would always mention the par value. Okay. And then 7% cumulative non-participating shares. Now, these are the different types of preference stocks. There is a difference in the preference stock and the common stock. Okay. So, who has not answered any question yet?
Yeah.
Sneha has not answered. Okay, Sneha. Sneha?
Hi.
Hi, Sneha. Yeah.
Yes.
What is the difference between the preference stock and I think most of us are aware, but still if somebody has forgotten, it's okay.
Okay. Difference between preference stock and common stock. That's what you're asking.
Yes.
Yeah. Basically, common stock means you get the ownership, and preference they're not giving you the ownership. That's what I understand. But however, the dividend paid is also a thing of a point of difference. That preference shareholders will be prioritized. Will be first given the dividend, and then at the last, the equity shareholders will be given their dividend.
Yes. So that's the biggest difference between the preference stockholders and the common equity shareholders, right? So this is what is basically mentioned here. Preference stock means preference in terms of paying dividend is first given to the holders of the preference stock, and then the common stockholders, they line up after all the amount has been first paid to the preference stockholders. Okay, the dividend. But tell me one thing, Sneha, does it mean that the payment of dividend to the preference stockholders, is this mandatory? That the company has to mandatory pay, because here they have mentioned 7%. So that means 7% dividend has to be paid cumulative basis. If you do not pay in 1 year, cumulative means that this gets accumulated. It has to be paid in the second year. You do not pay in the second year also. In the third year, it has to be paid for the first year, for the second year, for the third year. Does it mean that the company is legally bound to pay so much of dividend to the preference stockholders?
Yeah, it is somehow legally, but you can actually delay it. Yeah.
You can delay. So please, all of you make a note of this thing. If you are holding a pen and a paper, write it down that dividend is not a
Lost you in between. What is dividend is not?
most important golden rule to remember. Even if to the preference stockholders, it is not a liability until it is declared. Now,
No, we
if
missed
the
you.
preference
What
stockholders,
you were saying, dividend is what we note down?
dividend is not a liability of the entity. Even to the preference shareholders, the entity is not bound to pay the dividend until it is declared. So that means declaration happens only at the discretion of the management of the entity. It has to be approved by the shareholders. The management has to take that call that yes, in this particular year, we want to declare the dividends. We want to pay the dividends. And once that call is made, they would declare it finally. And once it gets declared, until it gets paid, this remains as a liability in the books of the entity. But
So
till
in
the
this
date of
case,
declaration, you cannot say that, because you have mentioned here 7% cumulative, this has to be mandatorily paid. No. It is completely at the discretion of the management. If they want to pay, they will pay. If they don't want to pay, they will not. However, to keep the valuation of the company high, the management will declare dividends if they have earned enough profits. That's a different thing. Okay. But so far as the legal obligation is concerned, it is not a liability. If on exam they tell you, look at these words, dividend declared or 7% cumulative dividend preference stock, non-participating, participating, whatever. Until that word declared is also mentioned along with, you will not create a liability for it. Remember that. Okay. So be it preference or be it common, same way of dealing with this. The accounting treatment remains the same. Okay. So
no.
10%, yeah.
One question, like you said, 7% cumulative, like once the company is declared. So are we going to pay backward? Like suppose past 5 years, they didn't declare. So are we going to create a liability for past 5 years for
Yes.
preferred
So
stock?
this is what the difference is. A preference stock
Right?
can be cumulative, it can be non-cumulative. If it is cumulative, it is still not a legal liability
Until
until
declared.
it is declared. So if in
But
the first 5 years, the entity declares, it has to pay from year 1, year 2, year 3, year 4, and then the
yes.
fifth year at the rate of 7%.
Okay. Once
If
declared, it will
decides
be the liability for past years as well, right?
past period also. If it
Okay.
is cumulative, it is
If it is
non-cumulative,
cumulative.
that means it does not accumulate.
Right.
In the period in which you are declaring, it becomes a liability only for that full period. We will read about the different types of preference stocks in detail in this chapter itself. Okay, so the common stockholders, as Payal has said, no, Sneha has said that they are the owners, the true owners of the entity. Why? Because they get the voting rights. Preference stockholders, they line in priority in terms of dividend payment over the equity stockholders, but the equity stockholders are the real owners of the entity. Okay, and they have the voting rights. Preference stockholders, unless it is specifically mentioned that they also have the voting rights, in most such cases, they will not have, as a general rule, no voting rights are given to the preference stockholders. Okay, so when on a balance sheet, all of this is mentioned. Along with this, they've also mentioned that there are 10,000 shares that the entity is authorized to issue as per its memorandum. Okay, and they have taken permission from the Securities and Exchange Commission to issue so many number of shares. But the entity has so far issued only 6,000 shares that are still outstanding. Lohit will tell me what is the difference between the number of shares that are issued and number of shares that are outstanding. Everyone understands authorized as per the articles of the company, okay, as per the legal documents of the company and permitted by the SEC because it is filed there. But what is the difference between the term issued and outstanding? Lohit, are you still with us or you have taken a break already?
No, yeah. I think number of issued share is nothing but a company which has issued, and outstanding is what the investors have subscribed.
The investors have
Subscribed.
subscribed. Okay. All right. So Lohit, I will tell you this with the help of an example which is given here in the common stock. Why? Because here in the common stock, which is the equity stock of the entity, 600 million shares have been authorized to be issued. But out of this, only 58 have been issued. But do you see that there is a different number which is given for the outstanding shares here? 58 have been issued, but only 57.178 are still outstanding. Right, Lohit?
Yeah.
Harshit, are you holding a calculator with you? Harshit?
No.
Then you please take a calculator. All of you take a calculator out. Or if you can do it yourself in your brain, then please do it. Minus 58, this number. Out of this, you reduce 57.178. From 58 million, reduce 57.178. What is the number that all of you are getting?
821,515.
How much?
821,515. 821,515.
I got it. Okay. Harshit, is this the number that you have also got?
Yes.
Harshit, is this not the same number that I have written here under the treasury stock at cost?
Yes.
What is the meaning of treasury stock? This means that this number is related to this number, Lohit, which means that the total number of shares outstanding and total number of shares issued has something to do with the treasury stock number. Treasury stock means that these are the number of shares that have been bought back by the entity, and hence, even though 58 million were issued, but as on this date, only 57.178 are held by the outsiders. Why? Because the difference between these two numbers, which is 821,515, this has been bought back by the entity. And therefore, this is written as your treasury stock, which is nothing but your contra equity account, which means that this reduces your equity. Because when you issue your common stock, you debit your bank account and you credit your stock. But when you buy back those shares, your treasury stock is a debit, and this reduces your value of the stock. You credit your bank account, you debit your treasury stock, and therefore your treasury stock is a number which is said to be your contra equity account.
So if in future the company can they release it again? Like if they want more money?
They can. All of this we are going to read in our next module, module 3 and 4. The valuation, how the treasury stock is basically valued.
In short, company is holding their shares, right? They are not releasing for the for general
If the
public.
company has bought back its shares, it can reissue those shares in the future. Okay. So the entity has few options. Either you can reissue those shares in the market, or if you want, you can just abandon those shares.
Okay.
Okay. So this we are going to do. The valuation of treasury stock is very interesting accounting. Okay. We are going to read this in our module 3 and 4. Then comes your paid in capital in excess of par. Sarthak, what is the meaning of this? Sarthak.
The amount we are paying above the par value of a stock.
What is par?
Par is the minimum value that is a legal capital that should be, paid for a particular share. And if we are charging anything above that, it is the paid-in capital.
And in India, what is it? Or what is this called? PIL?
Share premium.
Security premium, right? Share premium account. So this is basically the amount which is paid over and above the par value of the share, right? So Sarthak, what is the journal entry which is passed? If say, for example, the share's par value is 10, but I've issued it for $100. What is the journal entry that you would pass in your books? Sarthak? Sarthak? What happened? Disconnected? Harshit, what is the journal entry that you pass? I'm not audible to my participants.
Yes, audible.
Yes, you are.
Yes, yes.
But then nobody is answering. I thought everyone has left, or maybe some internet issue at my end.
No.
No, everything is fine.
Okay, all right. Harshit? Harshit is not there.
I'm there. I'm there.
It's a simple journal entry. Sarthak? Oh, some internet connection.
Maybe he's taking a break.
He has already taken a break. What is the time, by the way?
8:17. Sorry, 6:17.
6:07.
17.
7.
6:17.
6:17. Okay. So we still have time. Sarthak, kahan gaye? Sneha, what is the journal entry that we pass? The par value of my share is $10. See, this is a conceptual class. And every class will be based on journal entries. So if you look at the LMS, you will see many simple journal entries that you, all of you have already seen in your classes 11th and 12th earlier. So the par value of my share is $10. Okay. But what I have done is that I've issued it for $100. People were there available in the market who are ready to pay me more amount. Par value is the minimum amount. Okay. That Sarthak has said. I really don't think that Sarthak does not know this entry. Maybe some internet issue at his end. I know he can pass this. Yeah. So this is the situation here. What is the journal entry that I will pass here?
Yes. So here it should be
Bank account debit?
Bank account debit 100 to common stock 10 to additional paid-in capital 90.
9 or 90?
90.
Isn't it premium?
You can call it premium in India, but there you have to call it additional paid-in capital account. It is the same entry that you pass.
Okay.
Okay. Now, the significance. The significance of this bifurcation or division is this amount is not available, not to be distributed in any case, because this is the legal money. Okay. Legal capital of the entity that cannot be paid back to the shareholders. But in few cases, this amount can be paid. Additional paid-in capital, the security premium. So when we do, say for example, there is a concept called quasi reorganization. Okay. So this used to be a really heavily tested topic earlier. Now also it is a topic which is tested, not that heavily now. Okay. But once in a while, they still test you on this quasi reorganization. So sometimes there is an accounting adjustment entry that the entity has to pass because it has been suffering continuous deficits in the retained earning. So the retained earning is continuously showing negative balances, right? So to remove those negative balances, sometimes this additional paid-in capital is used. So all this money is kept in the security premium account and used for different purposes by the entity at a later point of time. Okay. So how do you get this money from? In most cases, by issuing your stock above the par value. Okay. So this is a simple journal entry. And I still know that Sarthak, you could have passed this entry, right? Some issue with your internet? Is not answering. Yeah. Okay. So this is basically what is there. Now, what is retained earning? What is retained
Amount
earning?
of profit which is set aside by an organization.
If I've incurred losses,
Then these retained earning will use.
okay, pass the journal entry to transfer. Pass. Who said this answer? Okay, you are
Kavya.
correct. You are correct. Who said?
Kavya.
Kavya. Okay, Kavya. Now you tell me one thing. Pass a transfer entry. I have made an income of $100,000 in the current financial year. Now transfer this amount to the retained earning from the income statement. What is the journal entry that you pass?
Retained earning to accumulated losses.
No, losses nahi hai. I've made profit.
Oh,
$100,000 profit, net income.
okay. So you made a profit. So it will increase our retained earning.
Yes, what is the journal entry? Retained earning is credited or debited?
So in this case, retained earning is debited.
Is?
Credited, sorry, credited. Vice versa होगा. Yeah, credited.
Yeah. So if I have to pass this is a simple transfer entry, right? So my income statement, I am closing at the end of the year. Why? Because in the income statement, I will not have any balances outstanding, right? Next year. So this particular year, after I've earned all the income, this amount, 100,000, this is closing. To what? This is closing to my retained earning, right, Kavya?
Yes,
Right or
yes.
not? It is getting transferred or it is closing because next year I will start my income statement with a balance, beginning balance. Will I start with a beginning balance my income statement or will I start it afresh?
Beginning balance, I think. No,
Oh,
no, I
really?
think fresh.
The difference between the balance sheet accounts and the income statement account is, let's logically see this. Every single account that you're seeing here on the balance sheet, this has a closing and an opening going in the next year. Pick up any example. Your liabilities. Last year, I had a liability outstanding for payment, $10,000. Will I close this account without making the payment? No,
No.
because end of the year, this amount was still due for payment. So my
Mhm.
next year starts with what? This amount as my beginning balance.
Yes,
Correct? If
yes.
I have my any amount in my trade receivables, if I have not received that amount in the year end, what will I do? Will I close it without receiving this?
No, we will transfer.
So that means the period change is not the deciding factor, whether this account in the balance sheet is getting closed or not. But period end is a deciding factor, whether this amount or account which is there in the income statement will close or not. Correct or not? All of
Yes.
you. Sumanta.
Yes.
Sumanta, tell me one income tax account which I do not close at year end. Anyone?
Income tax account.
Income tax.
No, any account. What you say? Any account or income tax account?
Any account. Let's pick up any income tax account. Not income tax, sorry, income statement account.
Okay. You do not
Any
close.
expense account, insurance, selling expense, any, let's pick up any, salary. These are the expense accounts, right?
Yes.
Revenue account.
Yeah.
What happens?
Depreciation.
Depreciation. Now you tell me one thing. When I pass this entry of depreciation expense to accumulated depreciation, I'm transferring it to the income statement.
Yes.
Right.
Finally, what happens is, this will help me arrive at my net income or not?
Yes.
Yeah. Yes.
So this net income is the final one balance that I get at the year end,
Year end.
after adjustment of all the incomes and expenses.
Yes.
Finally, all that net income is debited here and transferred to the retained earning.
Yeah.
Oh, yeah.
So that means all the income statement will have only and only those accounts that close at the period end. But the balance sheet is composed of only those accounts that has a closing and an opening balance every
Opening
year.
balance. Yes.
Correct?
Yes.
Yes.
My income statement amount closes in the retained earning. It is a credit in the retained earning, provided I am transferring my gains, I am transferring my net income. If, however, there is a net loss, which I am showing here, how will I transfer Kavya to the retained earning?
I think retained earning will debit it to income.
To loss. Yeah.
To income statement or losses.
Yes.
This is how I will close it now. So that means if this gets accumulated over and over period of time, this might lead to a situation where I have accumulated losses only in the balance sheet. How good is my balance sheet now looking to the shareholders? Today I have investors standing, okay, and they want to give money to me. That, okay, you want to start with your company's fresh ventures again, here is the money. But I am not happy to see this deficit in your retained earning. So the company will do what? The company will start a process. This process is called as a quasi reorganization process. So the company will say that, okay, all the losses that are there in my retained earning, I will just reset it to zero. So quasi reorganization is an accounting readjustment and not a legal reorganization, which resets the retained earning to zero. This is to show a better picture of the organization. This is an internal accounting adjustment entry that happens. Okay. Sometimes it is tested on your exam, not heavily tested.
So you don't need to show this to investors that you are doing this adjustment?
If the investors are smart enough, anyway, they will pick it up.
Okay. That's a question, right?
Because they will look at your comparative last year's balance sheet.
And it
So this
is
is basically
illegal.
to make a fool.
It is illegal.
So basically they are doing what? They will transfer the money which is there in the additional paid in capital to the retained earning. So the money which was otherwise available or could be paid to the shareholders from the additional paid in capital is now no more available. And this is happening all with the approval of the shareholders. So the outside investors feel safe now with the entity. They say that, okay, now the owners do not demand anything because this amount is not there in the additional paid in capital at all. Whatever surplus money they had paid earlier, that has been utilized to set off the deficit in the retained earning. So it is okay. Now we can start afresh. Okay. Now, this is the memory aid, and this is what you have to just go through quickly. Okay. I've spent enough time reading and making you all understand the balance sheet and every single item which is mentioned here. Although this is not an exhaustive balance sheet. When we do, but this is, yes, this consists of the major components at least that we will be looking into. Yes, after retained earnings, sorry, I forgot to take up this accumulated other comprehensive income. What is this AOCI, commonly abbreviated as AOCI? Anybody wants to take this question? Sneha, do you want to take this question? What is accumulated other comprehensive income? Very briefly, you can just tell me. Anyone who has an idea? Rajiv.
Maybe this income is from other than my main business, main operations.
Other than?
From the main operations, if I am earning from some other resources, then I take it to the other comprehensive income.
Okay. So what happens is that earlier this component never existed, or this element in the balance sheet never existed. Okay. But in last decade or so, more than a decade, I would say that this component has been introduced in the balance sheet. Now, what basically this means is, this says that, retained earning includes all the realized income of the entity. Okay. If you have sold furnitures and fixtures and you have earned gain, so that means you have actually earned that gain because you sold that furniture at a gain. If you have sold, you are a garment manufacturer, you have sold certain garments and you have generated some revenue. So that's your realized revenue that you have generated. Now, whatever you get after adjustment of the expenses from the revenues and gains, what you finally get is your either net income or net losses. And this gets finally transferred to your retained earning and the income statement closes. But what happens if I'm holding certain securities? Let's say, for example, if I'm holding available for sale securities. Okay, now where is available for sale securities pile? On the balance sheet. Can you tell me where exactly is available for sale securities on this page?
Yes. On the
Where is
non-current
this
asset.
mentioned? Under the head?
Investments.
Under the head investments. So what happens in case of available for sale securities? The accounting treatment basically is that if you're available for sale securities that you're holding, and you have arrived at December 31st, but you are still holding those securities, okay? The market value of those securities as on 31st December is $110. But you had purchased it 10 days before the year end. The price at which it was purchased was only $100. You intend to hold it for another month or so, and then you want to sell it off. Or you want to sell it off at any later point in time. But within this 10 days difference, okay? Now, if I write this down on a PowerPoint, I think this will help you all understand better. Now, what happens? This available for sale security, okay? The purchase price, the amount at which I had purchased it was $100. When did I purchase it? I had purchased it on, let's say, for example, 20th of December, year 1. Okay. Now, what happens is that I am still holding it on December 31st, year 1. I have not sold it. But now the market price has gone up suddenly by $10. So that means there is a gain of $10 which is anticipated. And the standard says because this is an available for sale security, which means that if tomorrow you want to sell it, you will sell it in the market. If you sell it in the market, the anticipation is that you will gain in that transaction because your cost price is less than the market price. And it looks like because of this anticipated gain. So the standard says that you have to recognize this $10 unrealized gain. But you tell me one thing. If I put this unrealized gain in my income statement, what basically I'm doing? And this is what used to happen earlier. This is a gain that I have not realized yet. It is not in my pocket yet. But if I transfer it to income statement, Sumanta, any gain on the sale of an equity share, if transferred to income statement, what is the journal entry passed? Only the gain.
Only the gain. Okay.
I'm not selling it yet.
To
You
gain
remember
account,
impairment?
impairment.
This
Okay.
is the reverse of impairment that I'm doing.
Loss.
Impairment is anticipated loss, which is realized on income statement. Why? Because all anticipated losses on the basis of conservatism principle, we follow conservatism. So all losses that are anticipated are immediately recognized, written off on the statement of income. All of you agree with this?
Yes.
But the conservatism principle on the other side says what? The unrealized gains should not be recognized on the income statement unless they are actually realized.
Actually.
So that means it is not fair to recognize an anticipated gain on the income statement. Correct?
Oh, that's why we are transferring it to accumulated? Okay.
Yes.
Oh.
Hence the logic. Do not disturb your income statement because your taxes are paid on the basis of income which is generated here. And then whatever is the net income, this gets transferred to your retained earning. Retained earning is the portion on which the shareholders keep an eye on, because it is actually from there that the dividends are declared. If you transfer unrealized gains to your retained earning, the dividends are not going to be unreal. You have to actually pay that dividend out of money which is just anticipated in future.
Okay.
Can you actually do this?
No.
No.
Then
Yeah.
what is the other
Makes
better
sense.
way?
Yeah.
Better way is, okay, let's take this unrealized thing out, transfer it not to income statement. I will increase the value of my available for sale security as I reduce the value of my asset in case of impairment loss pile. We pass that entry.
Yes, ma'am.
Here, because there is an unrealized gain, which is the opposite of impairment loss, I'm increasing the value of my security. But because I do not want to show it to the shareholders that so much amount is available for distribution in the form of dividends, I'm transferring it to another account which is called as other comprehensive income. And this amount will be only $10 transferred here.
And suppose in future, when we are going to sell it and the value get down, suppose it will be 105. So we'll reduce it by 5, right?
Yes. But you adjusted only in the OCI.
OCI, yes.
Until it is actually realized.
Right.
So that means OCI is meant for temporary parking of your unrealized funds. Now, as your net income finally is closed to your retained earning, all the amount which is in the other comprehensive income, be it loss, be it gain, whatever, this is transferred to your accumulated other comprehensive income. This is on your balance sheet. This is another component of your balance sheet.
Right.
Okay. So OCI is a statement which is sometimes prepared along with the income statement. So which means that in one statement itself, you show the net income, and subsequent to the net income, you start with all the items that become your OCI, items which are unrealized in nature. Okay. But what happens is sometimes you may want to show separately. So that's called as a two-statement approach. So when we look at Coca-Cola example, okay, so I've picked up one annual report from Coca-Cola that will show you that OCI is separated from your income statement by showing it in two statements. So one statement exclusively shows your net income, your EPS, everything is calculated on this. And then the other statement, which is a separate statement, but a subsequent to income statement, is shown, called as your statement of other comprehensive income.
Okay.
Now, a total of this. So I will just show you how it is done. So let's say, for example, I have calculated my net income. Sumanta, how do you calculate your net income? Simply from your revenue, I'm taking very, very
revenue
simply.
minus expense.
You reduce
Expenses.
all your expenses.
Expenses.
Okay. So along with your revenue, you have gains. Along with your expenses, you have your losses.
Losses.
Okay. Now the final amount after paying your taxes is your net income. Let's say, for example, simple number, $100,000 is my net income. So if I'm following a single statement approach of showing the other income, other comprehensive income along with this, okay, what will I do? I will simply, after this, start adding components of other comprehensive income. Other comprehensive income. Okay. Now the components of comprehensive income means that there are 4 items that can go to your other comprehensive income.
Coffee.
The common mnemonic that you need to remember is called PUF. Now this is called as your pension adjustments. Now what happens? This is also anticipated. Why anticipated? Because the employees who are working in your company, okay, for some time, to those employees, the pension benefits that have to be paid. Okay, so this is basically about the pension benefits or the retirement benefits that have to be paid by the entity at the time of their retirement. Now, these pension benefits are basically estimated today because it is based on their expected life, the employee's expected life, the total number of expected years the employee would work with us, the salary of the employee over this period of time, and the last drawn salary may be close to retirement. So all of this is estimated. Okay, nobody can estimate, nobody can arrive at the right exact number. To estimate this, the entities appoint valuers. The valuers will give an amount of liability that looks like that was on this date, so much amount of liability will be due for payment after so much time by the company to the employees. So all this liability is based on an estimate. All right. Now this estimate may go up with the change in circumstances in future. All of you agree? Maybe next year, the employee has left. I thought that the employee is not going to leave me for next 30 years. But the employee, he found a job better than mine and he has left my entity. Okay. So the entire estimate that I will be required to pay his pension amount, that post-retirement amount has changed. It has gone down. Sometimes it can go up also because of the change in the circumstances. Suddenly the laws have changed. Now the law is that I cannot recruit any person who has so much of qualification for amount lower than this. So that means minimum, this is the salary that I have to pay, which I had not earlier taken into account. So the liability, all of a sudden changes. Okay. So this up and down in the change of the liability amount, this will either lead to, if there is an upward liability movement, just pass an entry, accounting entry pass karo. Agar liability goes up, what do? Basically, a loss is debited and your liability is credited, because anytime the liability goes up, your losses have to be debited and your liability will increase with the credit. Correct? If because of this change in estimate, the liability goes down, your liability gets debited and your gain is credited. Now you tell me this up and down, going off liability because of the change in estimate, is it wise to transfer to the net income and distribute this amount to the shareholders in case it is leading to gain? Tomorrow, the entire scenario might change.
No, estimate is not the correct approach, right?
No, not necessarily that every time estimate will not be transferred, but at least in this particular case, which is highly dependent on factors beyond, absolutely beyond the control of the entity, it is not advisable. We will do this accounting in greater detail because this involves fair value determination. We also have to understand time value of money because the value of money will change over all these periods.
Right.
The liability value is not the money that, $100,000 that today I'm thinking I will have to pay. I will have to adjust it according to the inflation. Okay. So all those factors will play a major role in determining the estimate of liability. And therefore, in such cases, the accounting standard says that it is not advisable to transfer it to the net income. Let this fluctuation stay outside the income statement. Transfer it to the other comprehensive income. So let's say, for example, there is a $5,000 up in the liability. So if there is a $5,000 up in the liability, the gain is up. Now, the gain, I'm telling you, is not going to disturb the income statement. It will become really very volatile. So let me just transfer it to the other comprehensive income. This is yet to be covered in greater detail with more examples. Here, I'm only setting up the foundation for all of us for the next classes. Okay. Now, what is U? This is nothing but the portion that we have already studied. Unrealized portion of your available for sale securities. And from the previous example, we know how much amount? It was only $10, right? Let me just make it $10. Because I've invested not just in one security, I've invested actually in 1,000 securities. So I multiplied it by 1,000, I made it $10,000 up, unrealized portion in the available for sale security, which should not be available to my shareholders for distribution. Right? Now, this is your basically foreign exchange translation adjustment. What is foreign exchange translation adjustment? I'll tell you. There are two terms that you have to get familiarized with. One is translation adjustment. Another one is translation adjustment. Sorry. Translation and transaction. Foreign exchange translation adjustment happens when the parent company has invested in a subsidiary, and at the year end, the accounts are closing into the parent company of the subsidiary. The consolidation is happening. So if the subsidiary is located in any other country other than the parent's company, and there is a difference in the currencies that they are using as their local currency to make their financial statements. At the end of the financial year, when the consolidation happens, that consolidation will always happen in the parent company's currency. If there is an exchange difference between the two during the entire period and the balance sheet date, then all that amount is transferred to the translation adjustment account. And because of that exchange fluctuation, it is not advisable to transfer it to the income statement. The reason being that you are still the parent holding company of that entity. You have not disposed this off. So this will remain in the entity until you are still the parent company of that subsidiary. But at the time of your you are giving it away, you are selling off your investment in the subsidiary, then this amount is reclassified to your net income. So that means you will only have the net amount, because during this entire period of your holding, sometimes your income will increase because of the foreign exchange differences, sometimes it will decrease. So at the time of final divestment, you will only have the net amount available, which finally gets transferred to the net income. That becomes the realized loss or realized gain. Then it is okay. But during this entire period, if you keep disturbing, keep changing,
Hello.
then it is not advisable.
Karthik.
Okay.
Classes
Then, sorry,
ಮುಗಿಸ್ಕೊಂಡ್ ಮಾಡ್ಲಾ
sorry, somebody,
No, he is not on mute.
somebody has an issue. Okay. All right. So the last part of it is called as the cash flow. So this is basically from the hedge accounting. Okay. Cash flow hedge. This has to be read in detail. It is more in bar, less in FAR. Okay. But we will understand how the hedge accounting is done. Now, when you hedge basically a transaction, I'm not sure that how many of you are actually comfortable with the derivatives and hedge accounting. You only have a small conceptual understanding here that at times what happens that the companies, when they anticipate the risk, say for example, foreign exchange risk, okay, now they have heavy investments or they have heavy transactions with the foreign suppliers, and they think that, you know, maybe in future the foreign exchange rate will not support us. Okay, then to prevent that loss from happening, they invest in some other security or they invest in some other instrument which they think will give them gain if the currency decreases. So basically just opposite of what they are expecting from the foreign currency loss, they invest in the other instrument which they think will give them gain at a later point in time because of this foreign exchange difference. So when they invest in such kind of transaction, this is called as hedge accounting, which means that you are basically balancing the loss with the gain that you can make because of the fluctuations in the foreign exchange, which in one transaction will make you lose, but in the other transaction, you put it in such a way that that will give you gain, so that the net sum is zero. That gain should be mostly equal to the loss, or that loss should be equal to the gain that you are making from the hedge account transaction. Okay, so there are about 3 transactions. One is called cash flow hedge, another one is called as fair value hedge, and yet another one is called as your equity, you know, basically where in the subsidiary you are investing and there are losses that are anticipated. So that hedge accounting, this is called as your effective portion of the cash flow hedge. Now, what is an effective portion? I understand this sounds a little confusing. Unless we pick up a real good example, this becomes tough to understand because many of us have not done it before. So what is an effective portion of a cash flow hedge which goes in OCI? This one says that, let's say, for example, the loss that I'm anticipating because of the foreign exchange fluctuation is $100. But I've invested in some other instrument in the market which will bring me gain if the foreign exchange transaction or if the foreign exchange goes in the opposite direction. So that gain that I'm anticipating will be exactly $100. That is how I've invested. So that means it is a very effective hedge. Okay. So this is the effective hedge. Whatever happens here, this will go to OCI. Now you tell me one thing. If I'm saying that the loss is, well, in this particular case, it will be zero, but not necessarily that in every case it will be zero. There might be a case where the loss is 100 or the gain that I'm anticipating is only $10. Payal, how much was this effective hedging? Payal.
Yes, ma'am.
Is this an effective? Because this is the gain that I've got because of the hedge transaction. Hedge transaction means something that I've used to safeguard myself. But do you think that this was effective enough to safeguard the losses that were anticipated?
No.
So do you think this is an effective transaction in which I've invested money?
No.
So that means this is an ineffective hedge. Completely ineffective. You were not able to recover 90% of the loss. So that means it is an ineffective. However, if I say that, see, the loss that I'm anticipating here is though 100, but the gain that I'm anticipating is 97. Payal, do you still think it is not effective at all?
No, it is effective.
It is effective. So how much is the loss that is finally my loss? Only $3. Without this transaction, I would have incurred a loss of 100. Because of this transaction, now the loss is only 3. Transfer it here. This loss. So that means the effective portion of the hedge should get transferred here. Do we get it?
Yes.
This you will understand better when we do examples, but I think in the chapter 1, we will not give you any complex examples of this. Okay. Hedge accounting is a complex topic which is more tested in bar, less in FAR, but you should have some understanding of it. You should be acquainted with the terms called effective. You should get acquainted with the term what is hedge accounting. Cash flow, I'm not telling you right now in detail because there are different types of hedges. Cash flow is basically related to that type of hedge where you anticipate your cash flow changing. Fair value is the hedge where you use the term fair value because you anticipate that the fair value of your assets or liabilities might change in the future. Okay, so how you value and how you transfer the cash flow and the fair value hedge, that's different. But so far as the other comprehensive income PUF is concerned, it is the cash flow hedge where the hedge accounting effective part is transferred. Okay? No?
Yes,
You
yes.
don't agree?
Yes.
Yes.
Okay. All right. I know it is not, the last part is a bit confusing, but you will get it. Okay. We are just starting today. So all those amounts, the total of this, which is there in the other comprehensive income, will be transferred here. See, if I do a total of this, cash flow hedge, let's say, for example, there is nothing in the cash flow hedge.
Yeah.
If I do a total of this, how much am I getting?
15 pension adjustment and unrealized.
So under the other comprehensive income, what I'm getting is $15,000. Okay. Now what happens is that these are the transactions that are reported net of taxes. So this portion we will cover tomorrow, how it is given net of taxes. But let's only understand for the time being. Let's not complicate it with the taxes part. Let's say, for example, only 15,000 is the total amount. So that means my net income is $100,000. What is there in the OCI is $15,000. So the sum total of it is called comprehensive income. Comprehensive income. And the sum total of the comprehensive income, Sneha, is what?
Yes.
Comprehensive income means
5,000, 10,000.
net income plus other
Plus,
comprehensive
yes,
income.
1 lakh plus 5,000 plus 10,000.
1,15,000. Right? But on the balance sheet, I do not show this comprehensive income. On the balance sheet, this amount gets transferred to the retained earning. And this amount gets transferred to the accumulated other comprehensive income. So when we prepare a schedule of the entire equity, which is called as the stockholders equity, or we call it basically SOCI. Okay, statement of changes in the stockholders equity. There you show retained earnings separately, you show AOCI separately. Okay, let me quickly take you to that portion first, and then we can come back to this part, because this is given as a breakup here. And underneath is given your treasury stock. Okay, I'm taking you first to the, see, this is what a snapshot from your FAS website is. I will tell you how to do that research, because there is a research question also, which you will get on your CPA exam. So net income, this I've shown you was $100,000. Add your other comprehensive income. Sumanta, what is other comprehensive income? The components, learn it by heart. Do
Yeah.
it on a daily basis. Puff. What are those
Puff.
four?
Pension adjustment, unrealized gains or losses on available securities, cash flow hedges, and
The
Foreign
effective
exchange.
portion, huh?
foreign exchange translation.
Foreign exchange.
Yeah. So in this, there is one more thing which is actually merged with this in the puff mnemonic. They have included one more thing along with the cash flow hedges, which is also called as your the financial instrument.
It is specific to credit
Yes,
risk.
the financial instrument. This is your basically the risk part of the financial instruments. Okay, this I will discuss about this later tomorrow. They have merged it. Otherwise, I normally, do not merge it, but this is basically the F of it. Okay, so that's why they have included in this puff mnemonic here. Okay, otherwise if you want, you can remember this as 5 line items instead of 4. Okay, so it completely depends on your choice, because most of you are referring to Becker. In Becker, I think they have given only PUFF as 4 line items. Okay, so there is a fair value change in case of the debt instruments that happen, and that fair value is recognized in the other comprehensive income. So that part is there. All right. So if you want to remember, I personally feel that you should remember it in 5 points instead of 4 points. Okay. So if you want, you can just write it down on your notes that other comprehensive income has basically 5 points. Point number 1, Sumanta, is what?
Pension adjustment.
Pension. Sarthak, what is point number 2? PU. Sarthak, I think he has some internet issue.
I think, yeah, he having some internet issue. He just called me.
Oh, okay. All right. So, Kavya, what was you?
It's unrealized gains and losses.
From equity security, from trading security, from held to maturity securities, what?
From available for sale.
Available
For sale.
Okay. All right. And then what is F, Indu? The very first F?
Foreign exchange translations differences.
Translation adjustment. What is next F? Who wants to do it? Lohit. What is next F? Lohit is not there. Harshit. Harshit is also not there.
Not there.
Payal is there.
The effective portion of the cash flow hedge.
Okay. And what is the next, the fifth part of it?
Financial instrument risk.
Financial instruments. Yes. So that's basically the fair value changes in the debt instruments. Okay. So that we can learn as the fifth point of it. So anyway, when we do enough examples of it, you will remember that. So the other comprehensive income is added to the net income, and then what you finally get is the comprehensive income, right? This comprehensive income can be shown either as a single continuous statement, I told you, or it can be presented as a two-statement approach. So wherein you show it as a two-statement, you first show your income statement, write down your net income, and it should be shown as a continuous next statement of comprehensive income. But the total, whichever way you show, the total will be written as your comprehensive income. As per the definition of this, what is this basically comprehensive income? The change in equity or the net assets of a business. Why? Because this is part of the equity itself. During the period from transactions and other events and circumstances from non-owner sources, which means that equity capital coming to the entity is an owner source transaction, which means the dividends that are paid to those equity holders, that's owner source transaction. But when I say non-owner source transactions, of course, yes, the unrealized gains and losses are part of it. The pension adjustments are part of it. The foreign adjustment translations are part of it. The health transactions, cash flow effective portion of it, and the fair value changes in the debt instruments, all of that is part of the non-owner sources, which is adding up and becoming the part of your income. Even the comprehensive income, net income part, does this include any transaction from your owner source? Lohit, any transaction between the entity and the shareholders of the entity, is that any time entered in the income statement? Lohit, conceptual question. No, I am not audible to you, Lohit. You can't hear me? Rajiv, can you hear me?
Yes, yes.
Okay. So Rajiv, please tell me, is there anything or any transaction between the entity and the owners? That means, let's say, for example, the equity stockholders. Okay. Is any transaction between the entity and the equity shareholders, is that reported on the income statement at all?
No.
The capital that I've issued. So what are the sort of transactions that happen between the company and the equity holder? One is the issuance of the
equity.
capital. Another could be maybe the buyback of the shares from that party.
Right.
Yet another could be the dividends that are declared.
Dividend,
Right?
yeah.
So none of them is actually entered in the income statement. So therefore it is mentioned here that the comprehensive income, which is a total of the net income and other comprehensive income, does not include any transactions which are from the owners. So that means all the events and circumstances are from the non-owner sources. Right? It includes all changes in equity during the period except those resulting from investment by owners, correct? And distribution. Investment by owners is the issuance of share capital. Distribution to owners is the dividends that are declared. So the comprehensive income comprises of all components of net income and all components of other comprehensive income. Is this understood or not understood? Because it will form a very simple multiple choice question.
Understood.
Yes.
Okay. Now there is also one more thing that I want to discuss. What happens when you start writing your main exam? Okay. So those 5 testlets are populated on the basis of your performance of the previous testlet. So the first testlet is generally very simple. So many a times the questions that you would see in your Becker, particularly because there are many students from Becker here. So the Becker would prepare you very well to attempt that first testlet. Becker is actually very, very good source of preparation. But the second and the subsequent testlets that you see on your exam will be based on your performance of the first testlet. So if on that first testlet you have scored about 90%, expect a tougher next testlet. So the second one will be quite tough. The third one will be even tougher if you have performed really well in the second testlet. So if your exam is getting tougher from one testlet to another, it's a good news for you. Okay. But do not expect these simple straight questions going forward. So they will provide you as you progress from one testlet to another, more and more irrelevant and confusing data. The trick here is that in most of the questions, minimum 2 answer choices will be completely irrelevant answer choices that you can just look at and just ignore. But you still need to read all the 4. Okay, I'm talking only about the multiple choice question, which is testlet 1 and testlet 2. You still have to read all the 4 tests, all the 4 multiple choices. Okay, now only the 2 multiple choices that are left, they would be confusing. Okay, so your preparation should be based accordingly. When you are reading a question, always start from the question stem. When you are practicing on a multiple choice, 2 you will immediately know. So this is how the CPA exam is designed. 2 immediately you can strike out. But the other 2 ones, you still have to read all. Other 2 ones would be confusing. Now, if you feel that this one looks right, the other one is also looking right, because this will be confusing answers. Choose the most appropriate answer according to the case facts that are given. Okay, there is a possibility that your both answers are correct. Those one that are left. Your thing is that you have to select the most appropriate answer. You will learn it as we progress further and we practice few questions in the class. Okay, so we have enough number of questions that we are going to practice in our class also. But task-based, I will pick up after 2 weeks. Okay. Now, the number that you see here, this carries 5 points on your exam. Okay. Now, this is a research-based question. They do not expect you to remember any accounting standard codification. Now, what is accounting standard codification? Accounting standard codification is the standard number. Okay, like the other day when I was talking about revenue recognition, again and again I was saying accounting standard codification 606. 606. Here 220. So that means this is the main accounting standard for your comprehensive income presentation. The rest of those are the units, the paragraph lines, and the other numbers. Okay, so your one question will be based on your research. This carries about 5 marks on your exam. Okay, what you need to do is that pick up the keyword. It's a simple answer, and this is a very, very easy. These are easy points on your exam, no brain application, but they will give you one scenario. Like, say, for example, they will tell you that if you have to, if you want to read about an entity that reports comprehensive income in a single continuous financial statement, how should it present its component? Should it be in the 2 sections of net income or other comprehensive income? Should it be 2 statement or a single statement approach? What is the key word for this? The key word is income, comprehensive income presentation. So in the box that will be given to you, you have to type the keyword. This keyword will direct you to the website, which is FASB website. On that FASB website, these kind of numbers would be mentioned. So if you are able to find your answer and as close to that case which is given to you, as close to that you type the number, the more points that you get. So if you are not able to reach to, say, for example, according to the scenario given, 220, 10, 45, 1A was the correct answer, but you were able to reach only till 10 because, you see, herein underneath, many are given under the category of 10, but the exact case was about 45A, 1A. You will get few points for this. And the maximum points are for the very first part of the accounting standard codification. You are not expected to remember any numbers, but the key word understanding will come as you read more and more. Okay, I will take you to the FASB website also and I will show you what to expect there. Okay, now I told you on the Coca-Cola statement, I will show you how they have given the split between the net income, see the consolidated statement of operations. So wherever consolidated word is mentioned, that means they have combined the parent and the subsidiaries financial statements together in one. So at the end of this, you will get your net income, which is 633,125. Okay. Underneath this net income is given your basic EPS and your diluted EPS. Forget about this. We have not done it for the, at least right now. Okay. Let me now take you to the other part of it, which is the consolidated statement of comprehensive income. What is Kavya comprehensive income composed of? Comprehensive income is different from other comprehensive income. Indu?
Net income plus other comprehensive income.
Net income plus the
Other comprehensive income is the comprehensive
whether it
income.
makes up comprehensive income. So is this what we are seeing in this Coca-Cola consolidated statement of comprehensive income? So this is a two-statement approach. So whenever on any question, they tell you that we are starting from net income. That means the approach used is a two-statement approach, because herein in the statement of operations or your income statement, they have not shown comprehensive income at all. So that means the comprehensive income, they are starting from net income because that's one of the components which is used here. So in the net income, you add the components of other comprehensive income. Kavya, can you please read this? What are the components that you are seeing here?
Yeah, for other comprehensive income, net of tax, we have
Net of tax. So please remember this. If you are making notes, please write it down that the other comprehensive income items are mentioned in net of tax. So that means anything and everything that you are seeing here, already tax has been reduced from this number. Okay. Now please, Kavya, carry on.
defined benefit plans, reclassification including pension cost, actuarial gain, which is 3885 in
Which is
2024.
okay. Forget the numbers. Yeah.
Okay. Prior service credits, cost, post-retirement benefits, classification including benefit cost, which is actuarial gain, bracket
Yeah,
loss.
let's stop here. Let's stop here. So
Okay.
what Kavya has just read here. So he is basically talking about only P of that puffy,
Yes.
because this entire part is talking about the change in the estimate which is given by the valuer or the actuarial. Okay, so actuarial valuation, that's the complete term. He will estimate on the basis of information given by the management the total liability which is expected as on December 31st, whatever that year is. Okay. And on that basis, he will calculate this amount. Wherever there are losses, there are gains, that are all reported here under the head OCI. So from here till here, what you see is basically P of puffy. Yes, Kavya.
Yeah, I just have one doubt. Like, I think the pension part is removed from our syllabus, because I have heard this thing from somewhere.
Yeah. So who is this? Yeah. किसने पूछा ये?
Yeah,
काव्या?
Kav.
Kavya.
Yes.
So there are two types of post-retirement benefits. Okay. So one, the
Okay.
most complex one, which is based on basically your contributions. Okay. One is based on your contributions. Other one is called as the post-retirement benefit plan. Okay. So the post-retirement benefit plans is excluded. So what you are seeing here, right? So this valuation you will not learn in detail. But so far as the testing on other comprehensive income is given, they will give you one data that, this amount is given. Now, where do you adjust it? The valuation has been excluded, but you still have to understand the concept where it is transferred on the financial statements.
Oh, okay.
Okay. And then your pension benefits are also not 100% excluded. The benefit plans are excluded, but the contribution plan is still part of your syllabus. That we
Okay.
will learn later.
Then we have unrealized gains on short-term investments, pension plan settlement, and foreign currency translation adjustment.
Yes.
Then
So
we got
here they do not have any hedge transactions. What they do not have is the fair valuation of your debt instruments, right? The up and down of the risk, which is given in the financial instruments, right? So those 2-3 line items are missing here, but the rest are part of this. The total of this becomes your other comprehensive income net of tax, right? And what they have done is finally with the net income, which is 633,125, they have clubbed other comprehensive income. The total amount comes to 639. So this is the comprehensive income. There are times where they also call it total comprehensive income. So total comprehensive income should not be confused with the other comprehensive income. Okay? So these are some of the common confusions because of which the students lose their marks. Now, where is this getting transferred on the statement of changes in the stockholders' equity, as I was talking about, that this is basically called as your SOCI, okay? Commonly abbreviated as SOCI. Do you see this? Now, this is one of the schedules which is attached to this. Or this is not a schedule, basically this is one of the major components of the balance sheet. Financial statements. Now, do you all see here the common stock, class B common stock? Okay.
Yes.
Yes.
So this will contain all the details of your equity. Equity means what all items, Sumanta?
Equity means common stock, capital stock, and preferred stock.
The entire stockholders equity section is this. This we have done in the balance sheet also, Sumanta.
Yeah,
And we
retained
will
earnings.
back to
Yeah,
that portion.
retained earnings. Trading capital.
This is the part, right? So this is under the stockholders equity that we have one head called capital stock, which contains preferred and common. But then we also have in the same additional paid in capital, we have retained earning, we have accumulated other comprehensive income, and a contra equity, which is called as treasury stock. Right? So now all these details that you are seeing here, all these details will be entered in the statement of changes in the stockholders equity. Why we call it statement of changes in the stockholders equity? Because this will not only show just 1 year. See, what is this showing? We are starting from, this is 24 going on, right?
Right.
We are starting from December 31st, year 2021. So every single year, whatever changes are happening for last 3 years, we have captured those changes. So that's why this is called as the statement of changes in the stockholders equity. So that means we want to show the world how we have changed in the stockholders equity over the period of last 3 years. Now see all these heads, common stock. This is one of the head in the stockholders equity, right? Now we want to show how we have changed. No, this means that we haven't really changed much. See, in the 2021, 31st December, we had 10,214 common stock. But there was some conversion of shares that had happened. So conversion means maybe preference stock got converted into common stock, or maybe some debt got converted into common stock. Okay. So during this period, between 21 to 22, this happened. But post that, there has not been any change. Other than this, before 2024, there was some treasury transaction that had occurred. So this resulted in a reduction of my equity from 11,431 to 10,833. Why? Because the reduction was 398 minus. You all can see this clearly visible?
Yes.
Yes.
So therefore, we call it any number within brackets is a minus. Remember this, extremely important for your task-based simulation. Because in a task-based simulation, if you do not put a minus sign, if there are negative numbers or losses, then your answer will go wrong. Always remember this. Most of the times in the instructions, they mention that put a bracket around for the negative numbers. Okay. But even if they do not mention it, remember this. Now, this is a different class, class B common stock. So that means the classes are varied depending on the maybe some different voting rights that are given to them. Okay, so they may have more voting rights, they may have little bit less voting rights, or maybe, you know, in terms of some other preferences, there is a distinction made between these two common stocks. So that's why whatever are the different classes of common stocks that are issued have to be shown separately. And all the changes that have happened from 2021 till date have to be mentioned. So in class B, there has been no change at all. Okay. Now, additional paid in capital, EPIC. I told you that this changes because of certain transaction. There are maybe some liquidating dividends that have been declared. Maybe there are some quasi transactions that have taken place. There are some treasury transactions that have taken place that leads to change in the additional paid in capital. It increases if when you issue shares beyond par. But if you look at Coca-Cola, here in this particular case, there has been no change in the additional paid in capital in the past 3-4 years, right? Now come to retained earning.
Right.
Retained earning is something which you can expect to change every year. Why? Because every single year, some amount from the income statement will at least get transferred to retained earning. And if some dividends are declared, the retained earning is the first item from where the dividends will be declared. So herein they have given details of the dividends declared during the year 2022. So to the common stock, what dividends have been declared, to the class B common stock, what dividends have been declared. So this has reduced the retained earning. That means my retained earning has been debited by this amount. Okay. What is the journal entry, Kavya, which is passed for the dividends that are number 1, when they are declared, and number 2, when they are paid? Simple journal entry. Let's take this example, 37,354, Coca-Cola declared dividend.
Dividend to
When
dividend
it's
payable.
I think it should be retained earning to dividend payable.
To dividend
Payable.
Very nice. Yes, because as soon as I declare this, dividend becomes my liability, right?
Yes.
And on that date itself, my retained earning is reduced. So a debit entry
Yes.
is passed in the retained earning. Now,
Yeah,
when
and on the date when we are going to pay this amount to the shareholder, then we pass a entry dividend payable to cash. Hello?
Yes, simple entries. These are the simple entries that will get you marks on your exam. Okay, so this is what they have done in this particular year. Then again, they have declared some dividend in the year 2023. So this has also reduced their retained earning. So in the year 2024, again, they have declared some dividends. And there have been some share repurchases, which has debited my retained earnings. So when we understand how the treasury transactions are valued, then you will understand it better that why this amount has been reduced 598 from your so this is basically the par value which has been reduced. Yeah. What has been reduced in the retained earning is this, but in few cases, the additional paid in capital is also disturbed. Okay. So when we do the treasury transaction valuation, you will understand all of this better. But this is what has happened, and therefore now so much amount is remaining. Now the focus here should be on this 633,125. What is this 633,125, Payal? Where is this coming from?
Other comprehensive income.
Sorry?
Other comprehensive income.
Are you sure this is coming from other comprehensive income? Because
No. Sorry.
About
It is net
retained
income.
earnings.
Net income. It is net income.
Net income 633,125. Should we check it? See,
Yes, net income.
Net income 633,125. Where did I get net income from? I got it from the income statement.
Income statement.
Yes.
Income statement, this amount. So this finally went to the two statement approach, but the amount which is there at the end of the two statement approach will give me total comprehensive income.
Mm-hmm.
But
Yes,
on the statement of changes in the stockholders' equity, I still have to bifurcate it.
Right.
So
yes.
my retained earning is increased because of the net income. But what increases because of the other comprehensive income is the accumulated other comprehensive income or
Income.
loss. So here they have mentioned losses and they have put numbers in bracket. So this is what is there. Here they have not put brackets because ultimately there is some unrealized income. Okay. And remember, this is net of taxes. So 4,276 was the loss in the accumulated other comprehensive income, if you see, right? Under this head. Up to which year? Up to 31st December 23. But in this particular year, 6,161 has been added. So that means the total net income under the other comprehensive income is 1,885. Correct?
Yes, ma'am.
Where is this coming from? This is coming from here, other comprehensive income. Okay. What are the items that make up other comprehensive income? These are the items. Right? Now, after this, what do we have? We have treasury stock, common stock. Yes, the treasury stock is there.
Sorry.
Okay. Yeah. So we have then treasury stock transactions that have taken place, and finally we get one total equity amount. This total equity amount should actually match with your balance sheet.
Balance sheet.
Right? So these are the kind of, this is a practical example, can expect such kind of questions as your task-based simulations. They cannot ask you. So in a task-based simulation, they will give you multiple exhibits. Okay. So multiple tabs will be there, about 4 or 5 tabs will be there. Okay. So in the LMS itself, at home, tomorrow morning, or maybe day after tomorrow, just look at the task-based simulation. Don't try to attempt it. Let's cover some substantial part, and then I will tell you when is the right time to start looking into it, right? So just look at it, how the tabs are arranged.
Okay.
Okay. So the calculator will also be provided on the same screen. You can just go through. Okay. So I hope the comprehensive income, other comprehensive income part is clear. Right?
Yes, ma'am.
Bhavna,
Okay.
just one question. So why it is called like two statement approach?
This is called as two statement approach because we are basically preparing two statements. I will just take you there quickly. Just okay. So Sanjay had that doubt, or who has that doubt? Who asked me that question?
I asked Sanjay.
Kaun? Sanjay?
Yes.
Yes, Sanjay. So just read this first and then I will take you to the statement. Sanjay, हाँ एक बार आप इसको read.
Reporting comprehensive income. This subtopic requires an entity to report comprehensive income either in a single continuous financial statement or in two separate but consecutive financial statements.
Yeah. Then point number 2.
Point number 2, an entity reporting comprehensive income in a single continuous financial statement shall present its components in two sections, net income and other comprehensive income. If applicable, an entity shall present the following in that financial statement. A total amount for net income together with the component that makes up net income. B, a total amount of other comprehensive income together with the components that makes up other comprehensive income as indicated in paragraph 2201015.3. An entity that has no items of other comprehensive income in any period presented is not required to report comprehensive income. C, total comprehensive income.
Right. So just hold
Yeah.
on for a second. What they have mentioned here is that in a single continuous financial statement, they present the two components, but that's also presented in two sections. Okay. So one is just presenting it in two sections. When they present it in two sections, so what they do is that they first, so let me say that this is one piece of paper. So here they will calculate net income. Below this net income, they will calculate all the components, write down all the components of the other comprehensive income, and then finally the comprehensive income total is mentioned. But what happens is, this is one way. Another way is just one statement here and they end with net income. Okay. Second table they are creating here, which they are starting with net income as the base and then writing all the components of other comprehensive income. So this is called as a two statement approach. Why? Because they are basically creating two tables to write the or to show the comprehensive income. Okay. I will show you that part, but I wanted to first make you read this so that you understand where to refer to later. An entity reporting comprehensive income in two statements, but consecutive. So even if you are making two statements, it has to be one after the other. Okay. Table number one or statement number one will be statement of net income, which is mentioned here. And then the next will be statement of comprehensive income, which shall be presented immediately after the statement of net income. A reporting entity shall begin the second statement with net income. So anytime you see any question where they have mentioned or they have started with net income as the base, what should come to your mind? Okay, they are showing a two statement approach for the comprehensive income, which I have shown you, Sanjay, for Coca-Cola. Okay. So the Coca-Cola has done what? Herein is the income statement. Right, Sanjay? So they have not shown anywhere the other comprehensive income components. Do you agree?
Yes. Yeah.
So they started with net sale, then COGS. So this is basically the income statement alone with the net income. And then they have calculated the EPS, the normal income statement that all of us are aware of. Then what they have done immediately after this. So if you open the annual report of Coca-Cola, you will find this statement immediately after the statement of income. So wherein the statement of comprehensive income is now being prepared. Why comprehensive? Because this is the total of net income and other comprehensive income. So here, because they are preparing, it's a separate, different statement. This line that you see is a start of a different table itself. Okay. So incorporate it separately and then arrive at the comprehensive income. Right. Now, if I take you to this single statement approach, which is the statement of comprehensive income, single statement approach. Herein, do you see everything happening in the same table?
Yes.
Right. So the net income will go to SOCI. This will also go to SOCI, but in a different portion of SOCI. But this is how it is presented if they show it in a single statement. Most of the big entities, they cannot follow this kind of a single statement approach. Two statement approach, most of the big companies always two statement approach. Otherwise, the table or the statement becomes extremely lengthy to understand and read. Okay, so they cut it down in two parts so that it becomes more meaningful, easily understandable. Okay. Now, most of the companies examples that are available on net, it is a bit difficult to find a single statement for as a practical example to quote in class. That's why Coca-Cola and others are all easy. So if you look at Uber, okay, Uber is one of my favorite reports. I will go through Uber many a times. Okay. Coca-Cola also. Because, elaborately in their Form 10K, they have given so much of details in their disclosures, notes to accounts. It becomes very easily understandable. Okay. I will be reading all that. Sneha wants to go, come back and solve the MCQs and revise. Okay. Please do. What is the time? Okay, we can also stop today. I think we have covered pretty good amount because most of the financial statements, at least, I've spoken about the balance sheet. I've explained, at least given you a broad high level idea. This is what anyway we are going to take 4 months time to cover the entire set of financial statements. Okay, but let's just have a high level idea about each one of them in these fundamental classes. Now, this is the accounting standard codification 210. 2 minutes more, I will just tell you the snapshot of this, which is given in the resource itself. Okay. So you can do your little bit of more research at home before we come back for our next class tomorrow. So balance sheet, which is the statement of financial position given in accounting standard codification 210. Okay, so these are the complete set of financial statements which is required for general purpose reporting, which means that when I say general purpose reporting, I'm talking about the public companies, I'm talking also about most of the big private companies. But the small private companies, Kavya, what do they do? Is it feasible for a small private company or say a proprietorship or a partnership to follow the accounting standard codification? Prepare their financial statements like the way Coca-Cola, Uber, or Netflix, or all these big companies do? Is it really possible for small companies?
I think it's not.
No, no.
So the government also cannot be so harsh with those companies because the cost of making such financial statements is high. Gathering all the information which is required to make such financial statements, which involves at times the involvement of valuers, which involves which means that you need to hire really good accountants, the experts in their areas. The cost obviously will go high. The effort also will be so high. So looking at the bandwidth of such small private entities, it is not feasible for them that are small in their net worth. So for them, these general purpose financial statements will not be prepared. Okay, then what are the financial statements? After all, they also have to do some sort of reporting at year end. So the financial statements that are prepared by such companies come under the category of special purpose financial reporting. That we will do. What is special purpose financial reporting, Payal? Or the special framework which is used to prepare such financial statements?
That small companies who do not have the capability to prepare as per the accounting standards, so they will follow the special purpose financial statement reporting
Framework.
framework.
Any example of this? So, for example, they will prepare their financial statements not using the accrual basis of accounting. So they will follow cash basis of accounting because this is easy for people to understand. Less accounting work is needed. Okay. Compare and contrast this with the accrual basis of accounting. If you are preparing accrual basis of accounting for your income statement preparation, okay, so that means you need heavy lifting for this. If this is prepared using accrual basis, then we have to also prepare the cash flow because the cash flow is not based on accrual basis. Cash flow is the real cash transactions that have happened during the period. Okay, so this is an additional statement which is then needed to be prepared. And this you will see that cash flow statement, learning cash flow statement itself takes a lot of time. Then the gathering of all the data for this purpose takes another time and effort. Not really feasible for such small companies. Okay. So when I say general purpose reporting, I'm basically talking about those companies that are issuers, that are filers, that have their stock listed on any stock exchange in the United States or outside US. Okay. So those are basically called the issuers. So Securities and Exchange Commission Okay, it has made its own regulations, 1933, 1934. So they give their laws, these rules, which is contained in their elaborate articles and the regulations that define what should be the content of the financial statement, which is your part 2 of your this chapter. Okay, so once we are done drafting with the basic financial statements, then we will learn what sort of filing is required on an annual or quarterly basis. Okay, all of those are governed by SEC. So those big private companies and all public companies that are either in the process of listing their shares or have already listed their shares, they have to make their financial statements on the basis of what is laid down by the SEC. So balance sheet, your income statement, your stockholders' equity is nothing but the statement of changes in the stockholders' equity, SOCI, that we have just seen. That is there. We have already seen what is comprehensive income. Sumanta,
Yes.
comprehensive income we have seen.
Yes. Yes.
Easy to understand.
Yes.
Very nice. We also have to learn cash flow statement, which is extremely interesting. Okay. We will be passing journal entries to understand how a cash flow statement is prepared. So that's the beauty of your CPA FAR. Actually, extremely interesting for those who stick to the plan. If you leave it for a couple of days, or if you leave one class and you have not seen the recordings, after 1 week you come back, you'll find yourself lost. So nobody is going to miss, unless there is an urgency, a class. Number 2, please block my calendar. Keep blocking my calendar. Let's all keep chatting, talking, discussing. Okay. Stay very, very active in your WhatsApp groups. Any single doubt that you have, please post it. Don't worry whether we have covered this topic, not covered this topic. If we have not covered the topic, I will tell you. We will cover this later. But don't hesitate. Even the silliest question, you have every right to ask me, because here you are a learner. Okay, in industry, you are expected to be an expert once you have your CPA certification. I've already explained to you all the key relationships between all of them. Okay, so you can just revise. Now, this is where we will start from tomorrow. I've already spoken about these items in detail. Okay, but we will still, if anything is remaining, like say, for example, the different types of the preference stock, we will talk about in greater detail, but tomorrow. Okay. Now, all those in India, have a very good night. All those outside India, have a very good day ahead of you. Okay? So, I hope you were all able to understand. Are you
Yes,
able
Yes.
to
ma'am.
Yes.
get the pace?
Yeah.
The pace
Yes.
is fine?
Yes,
Yes,
ma'am.
yes.
Yeah, so this is what I don't like to really pace up. Every single word which is mentioned, every single word that you may be tested on, let's just do it. Okay?
So
Right.
what would be like tomorrow we'll start from that equity. So you want us to revise whatever we did today in class and you want us to do some MCQs as well? Let's
No,
go
I
through
think
those.
MCQs is not really required right now.
Not
I will
required
tell
right
you.
now? Okay.
No.
Okay.
Just need to revise the thing.
I will do the MCQ part first with you, and then you
Mm-hmm.
can start.
Okay.
You just revise whatever, because the basic foundation we have already laid. Okay, so
Right.
just go through the LMS resource part, because what I'm
Mm-hmm.
reading right now is coming from the resource.
Right.
Okay,
Okay.
so just read this part, and I think it should be good. If you are able to read little bit more, it will be even better, because I have gone many pages ahead from here also. Like
Okay.
this quasi transactions I've spoken about,
Mhm.
income statement I'm
Income
yet to talk about tomorrow. Okay, at least one thing that you can do,
Mm-hmm.
you can at least go through the income statement, at least one question of that income statement. FASB also, I'll tell you tomorrow that screenshot. Okay. See, there is one question from the income statement. Please go through this question. Try to do
Okay.
it yourself.
Okay.
This is given on, I'm not really sure what page number is this. The page number, I'm not able to see.
It should
Okay,
be on the top,
wait.
I guess.
This
270.
is given on page number
Page
20.
number 20,
21. Yeah,
21.
20.
20.
So please do this income statement. This is a trial balance which I have given here. Okay.
Okay.
There are two types of income statement. Don't bother about the income statement type. Only look at the what type of transactions have they given here or the accounts that they have given here. Okay. And out of this, how many do make sense to you? Because this is completely from your income statement accounts.
Okay.
Okay, very simple to understand. The answer is actually given here, not a problem at all. How we normally do here, the same thing you have to try it out there also.
Okay.
So we are
Okay.
referring everything on the elements, right?
Sorry?
There is no book. So right now there is no book. We are referring to the elements.
So this is the book, Rajiv. I have not given any hard copy. My cost really does not permit me to give hard
No, that's
copies
fine.
separately.
Yeah. So I am saying that it is mentioned in the LMS, and I have to go. We have to go through this.
You do not have LMS access yet?
I have the access. Yeah, I have to
Yeah,
go
so
through
you can just go through this LMS resource part.
Okay.
Okay. All right. Chalo. Then
Thank you.
I'll catch up tomorrow with you all.
Good night.
Okay.
Okay.
See you tomorrow.
Bye. Take care.
Bye, everyone.
Bye.